Has a greater intention to go than maybe some of the other members.
We should probably talk about some of the single stocks we're going to be watching here in Europe this morning. Keep an eye on SAP. It had a good run yesterday. Apparently more people want to join its early retirement scheme. Keep an eye on that. I'd keep an eye on some of the defence stocks as well. Keep an eye on names like Saab, maybe Dassault as well, that makes the Mirage 2000. Keep an eye on some of those names too.
Because the handoff from France of those Mirage to Ukraine will mean there will need to be some kind of replacement. You would expect they wouldn't do that without having that in the pipeline. We count down 2 seconds then to the open here. And as Guy was saying, not expecting fireworks, given that there will be a bit of a holding pattern ahead of that non-farm payrolls data, the jobs data in the US. But we will be scrutinising the house builders here in the UK on the back of the news around some Labour policies, Labour Party policies, and as well the chip makers, TSMC, just reminding us of the demand that continues within the AI space and whether that has a read across for the likes of ASML. Currently then checking in on the FTSE 100, modest gains of about 1/10%, 8,293, so building on the gains of this week so far. Over in Italy, the FTSE made about 4/10, and you're seeing very modest gains over in France, up 1/10% on the CAC 40.
Let's just deal with some of the stocks that we are. UK house builders. Are we going to see some rally? Are we going to see a rally come through there? That'll be interesting to watch out for. I think early indications are probably yes, that we are going to see maybe that trade coming through. Husqvarna is in terms of the percentage gains, is the lead in Europe this morning. But in terms of the points, to your point, it is ASML.
It's technology, ASML, another lift there. And, of course, this is the company that provides the tech that is needed by TSMC that, of course, dominates in the foundry space to be able to churn out those NVIDIA chips. So ASML benefiting on the back of that. It looks like Infineon is also getting a lift, ASM as well. So a number of those tech names. Infineon up 0.7%, BE Semiconductor. These are modest gains. ASML, again, up currently 6/10% so far in the session. We'll see how that builds, if it does. So modest gains, but it's had a very strong run-up in this week. The gains, of course, year-to-date are decent as well.
What I think is interesting is that Schneider, which is seen as a sort of AI trade, they make the kit for the grids that kind of go into the server farms. That's a little softer. Asia Brown Boveri, ABB, Asia Brown Boveri, is also soft, get that right, a little bit this morning. So it's interesting that ASML is up, but some of the other AI trade stocks here in Europe on the technology front are a little softer.
Darktrace, which, of course, took its home in the FTSE 100 yesterday.
Not for long.
So question marks about that, given that Thoma Bravo has agreed to take that company over. Darktrace is down 0.2%. Computer Center down around 2%. So there's some losses coming through from the software group Sage, but not much, just 0.1%. Across the FTSE 100, then, we've been looking at the home builders. Interesting, the miners as well. There's a little bit of softness coming in through some parts of the commodity space. Anglo-American down 0.9%.
We're making this all sound very exciting, but it really isn't.
I think Maria Weidmana is going to re-inject the excitement into this conversation.
We're waiting for Payros. Yeah, she's chuckling.
Hi, Maria.
Hello.
Thanks for joining us. You always bring lots of energy that's going to, outstrip the pessimism, the doldrums being brought to play by,
We're waiting
Guy Johnson.
We're waiting for 7:30 Eastern. We need a catalyst, and that's going to be the payroll number.
And Guy Johnson, by the way, is also on tenterhooks about Roaring Kitty and the live YouTube.
That's coming later as well.
That's also another catalyst. Maria, thanks for joining us. Where do we stand in terms of this equity market? Are the drivers there to keep this rally going? And do we need to dial back our expectations, even if this looks sustained? Do we need to dial back our expectations in terms of the kind of upside that we've seen year to date? Can that continue, or is this a more modest grind higher for stocks?
Well, it really depends where you look. So there is one part of the market that very, very excited. You're excited by something. So tech story is fantastic. It's doing well.
You're not an outlier there, Maria.
Well, I don't know. well. Like every time I go to a client meeting, people ask me, when is it time to sell? When is it time to sell tech? When is it time to go to small caps? When time to go to value? When time to go to Europe?
You
when
hate
do I
small
get...
caps.
Absolutely. With passion.
Yeah. So, so with a passion at one end, mega cap tech stocks, small caps, the exact opposite.
So what is your response to that? It's a legitimate question. At some point, the capex is going to be strained by these companies. The macro environment, of course, is going to be part of the factor, the yield environment, the interest rate environment. What is your response to those who say, look, valuations are looking a little rich. When is the exit from this trade?
So what is helping tech? Tech has, with AI story, it has been able to find a source of revenue that is almost independent. I mean, it can't be completely independent, but almost independent from business cycle, from interest rates, right? So we see strong demand for top line, right? So, I mean, today's news, we want more chips. Everybody in the chain need to produce more. So there is a top line story. And margin story is strong because tech has done its very, very hard work in the last couple of years. It cut costs, it cut headcount. It's not particularly sensitive to higher interest rates in the sense that balance sheets are fantastically strong. So top line is strong, margins are strong, so tech is making money. That is not true about the rest of the market, right? The rest of the market seeing a lot of pressure from higher interest rates, from higher labor costs, margins are getting squeezed, profitability is much, much more difficult and much more sensitive to what central bank is doing. So tech is kind of in a bubble of itself in terms of its profitability, right? Its earnings. So that's a great story, and I'm not entirely sure we're close to that popping, especially if we worry that central banks are going to maybe be a little bit too slow in terms of cutting interest rates, or the impact of interest rate cut will take a while to go through. So the economy is too slow.
So you've got the tech story and you've got the rest of the economy story. You talk about it being a chain. It feels like it's more like a cycle at the moment, though. You've got big tech wants to buy AI chips, and you kind of go round the cycle. ASML, kind of NVIDIA, it kind of goes round and round and round. It feels like kind of we're running around. If there's a crack in that chain, how quickly does it spread through the chain?
Yeah, no, that's a fair point. But what is really interesting to me is that, I mean, this AI excitement is capturing imagination from companies all over the spectrum, right? So I think it's really interesting that AI has been the most mentioned term during the earnings season, right? So companies from, I don't know, healthcare, industrials, material, any sector, they all talk about AI. But more than margins, more than earnings, more than economy.
When I ask CEOs, you talk to a CEO and you go, yeah, you want to talk about AI? And the follow-up question is, have you figured out how to monetize it yet? Do you actually know how the business plan is yet? Do you really understand the impacts it's going to have on your business? No. So the big question to my mind with AI is, and the question we still don't have answered yet, is kind of the ultimate monetization, the ultimate use case, how long that takes and how easy it's going to be to incorporate into business cycles. Until we answer that question, are we certain that this thing is going? Because NVIDIA's kind of price implies an awful lot of very good gains over the next few years, and the ability to keep EPS moving as well.
Yeah, I think the key maybe is a third question to those CEOs is that, okay, so you want to understand AI, you want to monetize it. You don't really know yet
how to do it.
But are you going to find out? Are you spending money to find out? And I think the answer to the third question is yes, they are spending money because they worry that their competitors would. Right?
Yep.
So I think because people are still want to find out, still want to monetize, they're still excited about it, so they are spending money on it and will continue to spend money, at least for kind of foreseeable future.
At least for the foreseeable future. When it comes back to the macro and the ECB, and this is something we're debating whether or not the cut that came through yesterday and the fact that they haven't given guidance on future cuts, is that a headwind for European markets, or are the elements there in terms of the growth story to be able to continue to give the upside, corporate margins, corporate earnings can sustain, even as we don't get clarity on when the next steps are for this ECB?
Well, I have to say I'm very old-fashioned about my investing. I want companies that grow. That's why I like tech and worry about small caps. And I think Europe is, I mean, I wrote a note, I gave them 3 Bs, bleak but better. So, I mean,
there's the buyback story, there's a dividend story.
Yeah, Yes, absolutely. And I think
there's a valuation.
And there is valuation story. But if you think about earnings, so what happened? Why people talk about earnings? So Q1 earnings surprised, right? So they were expected to go down 10%, and they gone down 5%. And I think people are excited about, okay, -5 is better than -10, but still minus. And every single sector except for except for financials in Europe have seen earnings decline. I mean, that's not. I mean, I'm not excited about investing in those companies. I'm more excited about investing into companies that can grow and can protect their earnings when the economy slows. And that's not Europe.
Does the rally broaden out?
No. So that's simple answer. But I mean, look, S&P is up, what, 12-13%? Small caps, couple percent. Rest of IFE is what, 5-6?
So I buy the S&P, not the equal weight.
Not equal weight, of course not. I mean, you buy mega cap if you can. Buy Nasdaq.
But you don't, because I've seen people talking about moving into the equal weight.
I mean, yes. I mean, if the idea is that, okay, they're cheaper, they underperform, they should mean revert. But why? I mean, they underperform because they're better companies, they grow faster, and that's what market wants. When we're about to go to slow down, you want to be in market leaders. You want to see companies that perform, and that's what gives momentum. You're not going for like reversal. You go to reversal when we're at the bottom of recession and things about to improve. We're not at that point yet. We're still getting into things getting worse, and that Fed will cut, and then cut more, and then we start recovering. So that would be a small cap trade.
Aside from the AI trade, which, as you say, is its own little kind of universe going on over there, the US consumer still seems to be quite strong. And that seems to be the trade that has given the US impetus.
Yep.
I spent the beginning of this week talking to a whole load of airline CEOs. I had Bastian, Scott Kirby over at United. They're all talking about the fact the consumer continues to spend aggressively. The TSA data points to that in the States as well. Ticket price, a boarding card are still being scanned at a huge rate. What is that? How healthy is the US consumer? People talk about this sort of K-shaped recovery. Some are doing great, some aren't.
Yes, yeah. I mean,
when does the K meet? Does the top come down or does the bottom come up?
Well, I mean, K-shape we talked about during COVID. So, but I think in US, because of such huge inequalities, there is a very different experience people have from higher interest rate. If you're asset owner, I mean, higher interest rate actually not bad for you. You have your house, you don't have to pay higher mortgage, you don't need to borrow money, and you make money on your savings. If you are maybe like in the beginning of your career and you need to buy a lot of things, you are much more interest rate sensitive, right? Yep. So there is a group of people who are doing quite well, and probably demographically it's older generation who already kind of amassed a lot of wealth. So they're feeling strong. And actually, I think it's really interesting the airline example you're bringing up, because the older demographics, they spend more money on services other than goods, right? Either healthcare, or they're fortunate to be in good health, they spend money on travel, on leisure. So they're going on trips, they're spending money on services. And maybe younger people, beginning of their careers, they spend more money buying goods.
Where does that take you on the consumer trade then? You got the essentials, the non-essentials, luxury. How do you've outlined, and there's a lot of evidence that backs that up, that differentiated picture when it comes to the US consumer. How do you trade along that?
I mean, I think it's a little bit company by company, so you find who is selling to that demographic, to richer demographic. I thought what was interesting is that, so we see as Fed actually, I mean, probably ties into macro, as Fed kind of delaying cuts and waiting for more evidence, we're seeing a bigger part of the economy going from, actually, I'm very comfortable, I'm doing well, to slipping towards that things are getting challenging, I need to refinance my mortgage, I need to update my loans. So you see kind of this dripping down this into more difficult territory. I thought was really interesting. Walmart said that they had one of the biggest increase in sales to middle-class people. So I think that's potentially a trade where people are trying to find kind of better deals, and those companies are benefiting.
Do you still like cash?
Yeah, because I do worry that it would be very difficult to avoid recession. So yeah, cash and tech.
But you've been talking about that trade for a long time.
Yep.
The longer central banks presumably leave rates on hold, the longer that cash trade continues to make sense.
Yep, absolutely.
And what would it take for you to get that cash deployed at this point? How high is the high is the bar? How much certainty would you need to have to deploy some of that money?
So I think a lot of it is deployed into tech, so it's not like we're wasting piles of cash, but that's a bit of recession protection. And as we were talking earlier, I think like value trade is coming, small cap trade is coming, just not yet. So I think more evidence of we are getting into like weaker data.
What would it take you to get into small caps? What do you need? You need to see a recession, right?
I need to see a recession, yeah.
And when do you think that comes?
Maybe towards the end of this year, beginning of next year.
Okay, so we're
getting there.
We're getting there.
Unfortunately.
Yeah, exactly. Maria, nice to see you. Have a great weekend. Maria Weidmana joining us, Head of Equity Research at State Street Global Markets. Thank you very much indeed. Let's take a look at the core six here in Europe, see what's happening with the big trades around the continent. ASML, obviously one trade that we've been watching in light of what we've seen, and Tom's been bringing us this with TSMC. So ASML is up and up like a reasonable amount. I saw the initial calls this morning of being only sort of 0.2, 0.3 higher, but it's actually up by a full percent. It's interesting that Schneider is not, but luxury is having a better day today. In the LVMH story, Tom has issues with whether or not these companies produce useful things.
I just have issues with your collection of Birkin bags. That's all. That's all.
I parked them next to what am I buying this morning? Ferraris. Yeah. No, Porsches.
You've got 12 of them. ASML. So I'm just doing the year to date on ASML because you're right. Look, it's a bit of a better day than maybe some had expected. Of course, you know you've seen strength year to date. The year to date picture is up 40% for ASML. So you continue to build on that. And again, they have this monopoly. They have a monopoly on the highest end lithography machines. No one else produces the top end that are needed for 2 nanometers and below in terms of the size of these chips. So ASML benefiting once again today. It's kind of closing up like 0.9% right now. We're looking at the real estate stocks as well here in the UK. The stocks around the house builders, of course, a little bit of a lift coming through for the likes of Barratt Homes. There's a policy announcement, it seems, from the opposition Labour Party around potential support for first-time buyers. So we keep an eye on that. And again, the chip story in the read across in Europe on the back of the growth that TSMC saw in the month of May, up 30% for TSMC, and that is lifting, as we discussed, ASML.
Defence stocks, interesting in the light of what we've seen in terms of the French deciding that they are going to provide the Ukrainians with some Mirage 2000, so we'll keep an eye on that trade as well. We should probably talk about Mike Lynch. Big day yesterday. Yeah. Huge day yesterday. We'll talk in more detail about what's coming up with this story. But Mike Lynch, in a court in San Francisco, the jury acquits him. This is staggering. This is a 10-year story that has been in the making. But we'll come back to that. We'll get you a bit of analysis on what is happening with that trade, with that story next. Not guilty. This was a huge fraud trial. Anyway, we'll come back to that in just a moment. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Charming British High Street, or Main Street if you're American, with its cobbled streets, picturesque pubs and cutesy bakeries. But there's an uncomfortable truth lurking behind the storefronts, because a lot of these stores are not owned by independent shopkeepers or even big multinationals. Instead, they're controlled by private equity investors.
So essentially, you could buy a really massive company and load it up with debt to pay for your acquisition of that company.
In fact, private equity has flown into the UK at an unprecedented rate since Brexit, hoovering up scores of high street names such as Burger King, New Look and Pizza Express. Now, as the UK adjusts to new economic realities, the private equity boom could pose a problem for the future of the British high street and the millions of people who work on it. Because most private equity is dependent on one thing: debt.
So when these deals go wrong, it can have real-world impacts. So it can mean higher costs of goods for consumers, and we can also see jobs lost.
The Bank of England has been worried about increased private equity ownership of British companies. They're worried about increased debt levels, and they're worried about the impact it will have on the British economy.
It's a bit of a theme coming out of that package and also from the Super Return Conference that's been taking place in Berlin. You want to get more? There's plenty more to be had on Bloomberg. That was obviously a Bloomberg Originals mini documentary talking about how private equity ate Britain's high street. Go online, find more of that kind of thing, and the production's great. It's really worth paying attention to. Anyway, I don't know how to pivot to the next conversation, but I'm just going to do it anyway. This is a much more serious issue and a surprising issue in so many ways. A jury has found British tech tycoon Mike Lynch not guilty of criminal charges. This was a criminal case. This relates obviously to the staggering loss that basically HP had to take on board. It's also a staggering loss for US prosecutors who had anticipated that they would be seeing him found guilty by the jury. Hewlett-Packard, remember, bought Autonomy, the software startup that Mike Lynch founded for $11 billion 13 years ago. He said ultimately he was the scapegoat for that deal that had gone bad. Let's get more. Jonathan Browning joins us to assess the situation. This is a big surprise.
It is. The US has an extraordinarily high conviction rate. If you end up in front of a US judge, the chances are you are going to prison. And so not only has he overcome that hurdle, but he's also overcome the hurdle, this intense pressure that has effectively been pursued by HP for over a decade. And then there was a case in the UK, a civil case, where a British judge considered a lot of the same issues and came to a different conclusion. So it's an enormous surprise.
Well, that's really interesting, isn't it? The civil case and the case in San Francisco and how the two results diverged. What does it mean for HP? As you say, they've doggedly pursued this case. How damaging is it or not for HP?
They've always claimed that they were the ones defrauded, that they were the ones that paid an enormous amount of money for the second largest software company in the UK, a huge deal, and then had to take the loss that came with it when they discovered that it was not quite what it seemed. Now, a criminal judge court, a jury, has come to a different decision and said, well, actually, we don't think that Mike Lynch has played a role in any kind of fraud at all. It leaves a huge question mark for HP because they have been putting a lot of pressure, and particularly also on the US, to pursue this case in the US as well as in the UK.
There is a big question about whether or not the UK should have sent Lynch in the first place, should have allowed the extradition to have taken place, given, as you say, the precedent that exists, that there was a huge likelihood that he would be found guilty. How do we see changes in the way that UK and other jurisdictions will treat similar cases in the future, do you think?
So David Davis, who's been an MP who's been a long-time supporter of Mike Lynch, was actually very quick off the blocks to say that this actually is another opportunity to look again at effectively what he says is an unequal treaty. He pointed to the case of the US diplomat who managed to leave the UK without a prosecution. And the question now is whether or not there is enough momentum behind it in the time of an election when there's an awful lot else going on. But he was very quick to say that there had been overreach by the US, and the UK and British business people particularly had suffered as a result.
We'll see if the next government looks to change that. And you're of course alluding to the US diplomat and the links to a fatal traffic accident, in fact, here in the UK, and the uproar that caused domestically in the UK.
You think about Starmer's history as well. Prosecution.
Chief prosecutor, of course, for the UK, if he becomes...
So in theory, he has some understanding of what is going on here, and therefore would be well placed, presumably, to take a different view, or maybe a changed view from the UK government. Yeah, if he wins on July the 4th, which remains, of course, a big if. Jonathan Browning, thank you very much indeed for the latest on what is a significant turn of event, of course, for the founder of Autonomy. Mike Lynch saying he's going to come back to the UK, come back to his family and get back involved in the tech sector here. He played a huge role in the tech sector about a decade ago, of course, being the head of the second largest tech company in the UK. Yeah, he talks about the fact he's basically lost a decade of his life.
It's personally, absolutely huge. Darktrace is an interesting company, of course, that he was foundational as well in forming that company, as we've said, now listed in the FTSE 100 and is being taken over Thoma Bravo. We'll see what role he plays in the tech space here in the UK. That's going to be interesting to watch as the fortunes change dramatically for the upside, of course, to Mike Lynch, formerly of Autonomy. We have some live pictures, I believe, of the Ukrainian Prime Minister Zelensky meeting. You can see him there live. This is Paris, where he'll be meeting with French President Macron. This, of course, after Macron promised those Mirage aircraft to be delivered at the end of this year. So he's going to be the defence minister. He met with Macron yesterday.
So this is the Ukrainian president meeting with the French defence minister. Yes. I think he's also going to be meeting the US defence minister as well a little bit later on, defence secretary a little bit later on. Plus he's going to be addressing the French National Assembly, which I think happens at the top of this hour. So he's going to go from here potentially to address the National Assembly. So we'll bring you those pictures as we approach the end of this hour. But these are live pictures coming from France right now. Up next, we're going to be discussing the European elections. That is a big feature of the landscape this weekend. We have an interview coming up with Marcus Breyer, Business Europe Director General. What does business want from these elections? We'll find out next. This is Bloomberg.
That move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Welcome back. You're watching Markets Today. We are 30 minutes into the equity trading session. I had to check because, to be honest, nothing's really happening. We are at a headline level, index level. We're a little soft. We're down by, 2-3% across most main markets this morning. We're waiting for the catalyst. That comes at 7:30 Eastern time this morning, 1:30 UK time, 2:30 CET. That's when the payrolls number will drop in the United States. There are things happening, though, here in Europe, more on the political front than maybe the economic or markets front today. European elections are now underway for the European Parliament. It's a vote that, of course, will help shape policy in the EU for the next 5 years. Let's go to Brussels now. Stephen Carroll standing by. Stephen, what does business want from these elections? What does it hope to see coming out of these elections?
Competitiveness of a question of how Europe competes internationally, that question around competitiveness very much in focus in these elections as well, because of course the performance of the European economy matters for all of the other important policy areas that are in focus in these elections. Things like the strength of the defence industry, responding to the war in Ukraine, addressing the Green Deal climate policies as well. If the economy isn't growing, if businesses aren't prospering, that makes achieving those targets much more difficult as well. And this is part of the picture that we've had leading up to this. There have been two important reports commissioned on competitiveness in the European Union from the former Italian Prime Minister Enrique Letta. We've had that report as well. Plenty of recommendations in those 147 pages as to how to make Europe work better. We're waiting on the one from the former ECB President Mario Draghi as well. So this is part of the conversation around these elections, and I'm glad to say we can discuss it further now with Marcus Behrer, who is Director General of the business lobby group Business Europe, which makes up 40 business and employers federations across Europe. Thank you very much for joining us to bring in your point of view on this discussion. Is enough about the issue of competitiveness being talked about in this campaign? It feels like we're looking other places for the challenges the EU faces.
Well, maybe not in the campaign, because the campaign is partly very national, but I think more and more people understand that we will need to do better next time. It's very clear, and you alluded to it, we are falling behind our global competitors. We see it everywhere in growth, in investment, in productivity growth. So it's very clear that we will need to do better next time. And I think people start to understand. And if you look at the last European Council, which talks about the new competitiveness deal for Europe, that's what we need. But now we need to fill it with life.
How much time does this new Parliament and the new Commission have to get moving on some of those plans? Europe, at a European Union level, not known for its speed when it comes to policy making.
Well, I think we'll need to move rapidly. I I think we'll need to, of course, after the elections, the institutions will need to be established. But then I think we'll need to start rapidly after the summer break, because we need to send a signal to the companies in the first year that it will be worse again to invest in Europe. So we need to return the tide. And talking about elections, I think successful companies, a successful economy is the best remedy against populism.
Are you concerned about a differently composed European Parliament with perhaps more populists in it that might derail some of the policies that you want to see?
Well, I think it's clear that the extremes on both sides of the spectrum might be strengthened a bit. But I think and I hope that there will still be a sufficiently strong center, understanding that we need to bring the continent back on track. And then, of course, there will need to be majorities, including all rational forces in the parliament. And I think with goodwill, this will be possible.
Is the answer here more European money? Does the budget need to be expanded? Do you think that's a realistic approach to get some of the policies moving and some of the changes in the way the internal market works?
There will be things that necessitate money. To bring one example, we'll need to think about how will, just one major example, cross-border energy infrastructure be financed. But the main point is to get the investment conditions right, because it's not only about money. There's a lot of money available. If we look at the Horizon Europe, not everything is spent, so there can still be money mobilized.
Is that a red tape problem? Why there's money out there? Why aren't companies accessing it?
There's a big red tape problem, and then if we look at, we have created our campaign with the Reboot Europe. We say the computer is right. We can only do together as European, but there's a couple of bugs we need to fix. And our members tell us, we have been losing out towards our global competitors in the last 5 years. And we also ask them for the reasons. And beside the cost of energy, where we need to find answers, it's a lot of over-bureaucracy, regulatory overburden. They tell us they're drowning in regulations, and that the permitting procedures to set up an industrial plant and infrastructure are taking too long. This is where we need to get better. This is where we need to find answers. And this is, for instance, what the US seems to do better.
What's the risk if you don't have action, let's say, in the next year on these issues?
Well, I think the mood is rather in the direction of action. I think if you look at what people say, or what major players say, what the European Council has said in this new competitiveness deal, more and more understand. I think the biggest risk is that we might fail to translate into action. So I think we need to translate these right messages now, where people understand that we will need to do better, we will need to be faster, we will need to put competitiveness on top of the list again to be successful, that we translate this into action. And I would say we need to show to the companies in the first year that it's worth to invest in Europe again. The investment flows have gone elsewhere. And this is what we need to turn around, because we want the wealth in Europe, we want the investment in Europe, and we want also to create quality jobs here.
Okay, and the sentiment question, key to that as well. Michael Speyer, thank you very much for joining us, Director General of the business lobby group Business Europe. Great to have you with us in studio ahead of those elections. Voting taking place, Guy, today in Ireland and in the Czech Republic. The rest of the EU member states, after the Netherlands voting yesterday, will vote between now and Sunday, and we'll have the first projections of the new European Parliament on Sunday evening.
Okay, great stuff, Bloomberg's Stephen Carroll in Brussels. Thank you very much indeed. There's plenty more coming up. Stay with us. This is Bloomberg.
what are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back. You're watching Markets Today. We are 39 minutes into the equity market session. We are waiting for the jobless data to cross in the United States. 7:30 Eastern time is when that data will drop. It's going to be the catalyst for today's session, certainly here in Europe as well as over in the United States. Yesterday was the ECB. Today it'll be this data, certainly that I think probably sets the tone. This week, though, has been much more, you could argue, about politics. And we've seen this represented in a number of different forms. We've obviously been watching the elections, but this week has also been a week when we've seen Europe and the United States come together. We've seen the D-Day celebrations, June the 6th. Yesterday, President Biden has been in Europe all week, and he has indicated that democracy is at risk around the world, and he's making reference to what is happening in the Ukraine. The US president making remarks yesterday at the ceremony marking the 80th anniversary of the D-Day landings, where he also hailed the importance of alliances such as NATO. Now, remember that President Biden is also going to be meeting President Zelensky a little bit later on. President Zelensky, out of interest, is going to be giving a speech in the French National Assembly in around 10 minutes' time. We'll try and bring you some early parts of that conversation. So Europe and the United States have come together this week, but does that apply to the business relationship that we see across the Atlantic? So let's delve into how that is evolving right now. We're joined now for an exclusive conversation with Sarah Morgenthau. She is the U.S. State Department Special Representative from the Office of Commercial and Business Affairs. Great to see you this morning. Thanks very much indeed for joining us.
Thank you for having
me. How easy is it? How free is trade? We talk about the kind of the special relationship that exists in the geopolitical theatre. How easy is that relationship How easily is that relationship working when it comes to business?
Look, the U.S.-UK bilateral relationship is extremely strong. We're seeing that play out with D-Day yesterday and the importance of our two countries. We're seeing that play out in the Russia-Ukraine war, where we are grateful for the close relationship. The trade relationship between the United States and the UK is one of the most significant and consequential for both of our countries. And we're grateful for the close coordination and collaboration. You know, in our country, President Biden has made it a priority to really invest in our country and also for the benefit of our allies. We all lived through the pandemic, through supply chain disruptions, hollowed out grocery stores and businesses that were really having a hard time because they had been too reliant on one partner. We have seen the passage of CHIPS and Science Act, of IRA, of infrastructure. And these are things that we are doing in the United States that are also benefiting our allies. BAE, one of your companies, has taken advantage of the Chips and Science, I think got $35 million to expand in the United States.
Yep.
And we see that as a good thing for our country, for your country, and enormously beneficial.
Some over here see some of those acts, the IRA, CHIPS Act, as being protectionist. Why is that not the case? You talk about the benefits that accrue to businesses outside the United States, but there are quite strong elements built in to that legislation that requires a certain amount of production in the United States, a certain amount of the supply chain to exist in the United States. To many people over here, that feels protectionist.
You know, I just gave an example of BAE, which is a UK company, which is allowing to grow globally. We are all getting ready right now for our Select USA conference, the biggest global conference of businesses, delegations from around the world. The UK, I believe, is sending 50 companies to the United States for the opportunity to expand their companies. I think that part of this is because of the investments that we have made in our country that we see as benefiting not only our country but our allies as well. You know, the business community is knocking on our door at the State Department for things all over the world. And I am seeing great investments, for example, in Kenya. We are very fortunate to have the U.S. Ambassador Meg Whitman, who was the former CEO of Hewlett-Packard and eBay, and she has been in very close coordination with President Ruto in Kenya about instituting some reforms to make the business environment in Kenya better for the United States, better for the UK, for countries around the world. And you're seeing in that $1 billion of investment.
The Inflation Reduction Act, and it comes in combination with stronger growth, of course, in the US and the catalyst that comes through with AI, a number of compelling factors to draw investment to the US. But there is a real and substantial argument about the fact that we see executives here in Europe saying, I'm not going to invest in this factory because I'm getting subsidies that we cannot match, whether it's in Europe or in the UK, and we're being drawn to the US. You can understand that's a legitimate concern.
Yeah, I understand that's a legitimate concern. I think that you are still seeing, like I said, we've got 50 companies here, you know, coming to the United States. We're working together. Prime Minister Sunak and President Biden have worked on the Atlantic Declaration, and there you are seeing our two countries, as we have done for so long with our enduring strong relationship, tackle things like AI, like technology, like defense, like health. And so I think that there really is a like-minded view of our two countries that will benefit our business community.
On China, you can certainly make the argument that the UK and the US have rarely been this aligned on the question of China. We'll see if that changes after the UK elections, July the 4th. When it comes to the question of China, are you taking a bit of a note from the playbook of China when it comes to the question of subsidies and supports for key industries? China would say, look, you've been subsidizing your energy industry, your auto industry. There was a bailout in 2009. What's the difference?
You know, I think that we have President Biden, we've seen Secretary Blinken talk about a strategy of what you would say invest, align, and compete. And so we are doing significant investment, the Chips and Science Act, IRA, infrastructure, you know, all of this to make it so that our companies in the U.S., the companies of our allies, including in the UK, are able to compete and are able to go to other trusted partners. I have spoken all over Europe about the importance of 5G, of cargo scanners, where it's important that we use trusted vendors that are not taking our data, that are not taking our IP. And I think that we are grateful for that close collaboration and like-mindedness of our allies, and especially the UK.
Sarah, thank you very much indeed. Really appreciate your time. Thank you for coming to this show this Friday, joining Guy and myself, of course. Sarah Morgenthau, US State Department Special Representative from the Office of Commercial and Business Affairs. We're going back to the decision from the ECB. We're getting some lines from ECB officials now. So we go back to the central bank monetary policy story, because the Irish central bank governor, men of the ECB then, coming out, Guy, with an interesting line. It's a red head on the Bloomberg terminal, a little bit move higher in euro dollar. And the Irish central bank governor saying, we don't know how fast the ECB will carry on, If at all.
It's the if at all bit.
Yes.
If you take that to its logical conclusion, say we get to the if at all, say they're one, is he implying they're one and done?
Mark Loof from the Irish Central Bank, if at all, was that a misspeak? Was there real weight and emphasis put on that? Not traditionally seen as a hawkish member of the spectrum, I don't think, from the ECB Governing Council. All the other speakers so far this morning have aligned with what we heard from President Lagarde. This comment pushes things in a more hawkish direction,
It certainly does, and I wonder whether that's a reflection of the conversation he had round the table yesterday in Frankfurt, and whether he's picking up on a theme that is developing there, that maybe actually this may have been one and done. Maybe we don't need to go much further. Say it gets pushed out, the next cut, beyond September. This cut is going to feel increasingly isolated. And I wonder how that is, as time progresses, how it's going to, if that's how it's increasingly going to look.
And of course, part of that isolation, and to what extent that remains an isolated cut, will come down to what happens with the Fed, and then we get the non-farm payrolls to date. Maybe that gives us some more clarity in terms of the jobs front and what that does to Fed expectations. In terms of the market reaction then to this comment from the central bank governor, ECB, you're seeing yields up just marginally in terms of German two-year debt. Bunds yields up just 2 basis points. Not a huge move. A little minor pop in euro-dollar, but nothing substantial really at this point. And again, there's been a lack of volatility around this currency. A little bit of strength yesterday, to say the least. Right, 108 right now on
we have
euro-dollar.
been in a trading range for this pair for really quite some time.
Yeah.
And it doesn't feel like anything is going to shake it out of that. But say the ECB didn't cut much further, I wonder whether that would provide some upside catalyst for maybe certainly a move towards the top end of the range. At the moment, the market is pricing in 2 cuts from the Fed this year. Maybe the ECB and the Fed maybe aren't as unaligned as maybe we first thought or assumed, and we assumed that we would get this divergence. Maybe that divergence is converging.
And if we get other voices that build on this comment from the Irish Central Bank governor, then maybe that will become clearer. We still, of course, have a lack of clarity until the next steps, and they're making a point that they've come through with this cut. They're going to be day dependent from here on. 3.75, of course, on the deposit rate for the ECB, and the Irish Central Bank governor again questioning whether or not there will be other cuts at all, guys.
So we'll talk about this in the context of what is happening at 7:30 Eastern today. We are waiting for the jobs data out of the United States. Indications, certainly so far with the recent data, is that we are seeing a slowing when it comes to the labour market. The labour market in the United States is beginning to loosen up a bit. The survey number is 180. The whisper number is 160, so it maybe feels like the danger is that the market is setting itself up maybe for an upside surprise here. Let's get some thoughts on what is happening here and what the market setup looks like. Ven Ram, Bloomberg's Market Live, Ven Ram joins us now from Dubai. Give us the setup, Ven. What does the market look like going into this number?
Morning. I think that the market setup is going to go much beyond the headline number. We will get an expansion, and it'll be one of the many successive months of expansion that we have seen. So the markets are not likely to move on that number alone as much as it hogs the limelight. What is more crucial to the market's calculus are 2 things. One is the earnings growth. That is at 3.9%. That is not enough. That is not congruent with the Fed's 2% inflation target. And the other number, equally important, is the jobless number, again expected to come in at 3.9%. Now, the Fed reckons that you need a jobless rate of 4% or higher for this jobs market to rebalance. And until those 2 things fall into place, the headline obsession is not going to do too much to the rates. I think that rates are going to be higher for longer. If you look at the inversion in the yield curve, we have had it for almost 19 months now. That's the longest inversion in modern day history. And that tells us something about how premature the bids towards duration has been.
19 months. The longest. We were banging on about this, weren't we? And then we just got tired of it. The inversion of the yield curve. 474 on the 2-year, 429 on the 10-year. Ben, given that then, the market's pulling forward expectations of cuts from the Fed this week, marginally, from December to November. September still seems to be in play. Where do you land on that?
Well, I think that the markets are in a guessing game as opposed to divining the Fed, really. A lot of it will come down to what the Fed is going to show us with the dot plot. I mean, of course, nobody expects them to cut 3 times anymore this year. So the question is whether the Fed is going to indicate 2 or 1. And I would err on the side of 1 cut, Tom, because there is just not that momentum. Okay, the U.S. economy is softening, it's cooling and all that, but it's just not giving the Fed enough headroom to cut rates yet. We know that the economy is losing momentum, but if you look at the jobs creation, if you look at the big picture, it is still one of economic resilience. And no one is even talking about 2% inflation anymore, because now it's become the 3% is the new 2%. So if 3% is the new 2%, if we would be lucky to get 1 cut.
Okay, lucky to get 1 cut. Let's bring this back to the ECB. The Irish Central Bank governor out on the tape just a couple of minutes ago. Don't know how fast the ECB will carry on, if at all. Then, if the ECB's one and done, how big a market adjustment do we now need to see?
Well, the markets, I think the markets are kind of, if you look at the German yields, German bonds have sold off this year, in a year when the ECB is supposed to be cutting. That tells you a lot about how skeptical the market is about inflation. That is just one segment of the market. If you look at the other segment of the market, the OIS market, they're thinking that we may still get, 2 rate cuts this year from the ECB, but I think that it would be prudent to expect just 1. Just this morning, on the terminal, it's available. If you look at the inflation projections from the ECB, predicting 2.2% inflation next year as well. They revised it higher. So they are essentially saying we are going to miss the inflation target even in next year. And the latest we can achieve inflation congruence is in 2026. If that is going to be the case, and if you assume a neutral real rate of 50 basis points, that doesn't give the ECB too much room to cut rates, which is why I think that the Irish ECB speaker is bang on the money when he says, if at all.
Okay, 1 cut from the ECB, 1 more cut from the ECB, 1 more cut, or 1 cut from the Fed, still waiting for that. What about the Bank of England, Ben?
The Bank of England is in an interesting situation, Tom. I mean, they've been wanting to cut rates. They've been wanting to take rates to what they think should be lower restrictive levels. But the thing is, I mean, they are expecting inflation to converge to 2% in the spring. And they set a lot in store by the April reading. Governor Bailey said it himself. They were expecting a reading close to 2%, and what we got was an overshoot. If in the best month, they were expecting inflation to touch 2%, and we didn't get that. And by their own admission, inflation is going to accelerate after that. So I don't think we are going to get 2% inflation in the UK anytime soon. Anyone who lives in the UK economy knows that 2% inflation is a myth. You just have to go to the supermarket to find out that's a very big myth. So the headroom for the Bank of England to cut rates is just simply not there. If you look at services inflation, it's hovering around 6%. Is that compatible and congruent with 2% inflation? I don't think so. So, the BOE is mispriced completely out there.
Ben, great stuff. Thank you very much indeed, Ben Rahm, joining us on what is going to be a big day, certainly for the macro story. We await the payrolls data at 7:30 Eastern. We've got some great coverage coming up of that event. In terms of what's about to happen, Volodymyr Zelensky is going to be addressing the French National Assembly. I can't see the feed on that yet. I know Lloyd Austin's just been presented with the French forces in Paris, so that the US Defense Secretary is in Paris. But we're waiting for that National Assembly speech, which will be coming up very shortly. I thought it was going to be at 50. It looks like it's maybe drifted in terms of the timeline. What else are we watching? Apple's going to be a pretty big deal Monday, isn't it?
Really, really significant in terms of the update on its AI strategy. There's been a lot of bated breath, a lot of waiting in the wings for the detail on this. So we'll get that on Monday, a big, big story. We're going to be speaking as well to the co-founder, Steve Wozniak. Stay with us, plenty more. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And market movers. This is The Pulse with Francine Lacqua.
Friday the 7th, good morning. Welcome to The Pulse. I'm Guy Johnson in London. Francine is out today. But let me tell you what's coming up on today's programme. European stocks and Wall Street futures steady. I think that's the polite term. Markets basically awaiting 7:30 Eastern time. US jobs data expected to show that the US labour market is slowing. We'll keep an eye on that data as we work our way through the day. ECB officials, let's turn back to that, cautioning this morning on any rush for more cuts. This after, of course, we saw yesterday the Governing Council delivering on its promise to lower rates. That feels increasingly isolated, doesn't it, that rate cut? Plus, President Zelensky is set shortly to address the French National Assembly. This after we saw yesterday Emmanuel Macron promising Ukraine more military support, including Mirage 2000s. Let's talk about what is happening with the European market story this morning. Don't get excited about this. Nothing is happening. We are waiting 7:30 Eastern. That's 1:30 UK time PM, 2:30 CET. That's when the US data is going to drop. That's what we're waiting for. So European equity markets are doing nada this morning. We're going to wait for that data. That's the next big catalyst after we saw the ECB yesterday. Let's run you through the data elsewhere and show you what is happening. US futures doing nothing. Ignore that. The yield is going to be important today. That is going to be potentially where we're going to see some of the biggest price action. Not on the 10-year, maybe at the front end is where we're going to see some action today. The market's expecting the survey's 180. The whisper number's 166. Maybe the market is set up for an upside surprise, so maybe we see yields going higher. Euro dollar unchanged, which is interesting given the comments we've been getting through from the ECB Governing Council members this morning. Crude doing absolutely nothing either. Basically, we are waiting to see exactly what is going to happen with this payroll story. So that's the catalyst today. The catalyst yesterday was definitely what we got out of Christine Lagarde. So we've been committed, the ECB's been committed to a rate cut in June for absolutely ages. We delivered that yesterday. But now Christine Lagarde has decided she's going to put a poker face on. She's not going to tell us what comes next. When does the next rate cut come? She was definitely not delivering on that as a pitch yesterday. She's not going to tell us anything. We are data dependent. Let's take a listen to what she had to say.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data.
It's 8:30 Eastern. That's when the jobs data's coming through. I've been saying that all morning. Somebody would have corrected me a little bit earlier on, you would have thought. Anyway, let's talk about what we got from Christine Lagarde. Let's talk about what we've got this morning from a whole series of ECB speakers telling us that we are not committing, and actually the Irish Central Bank Governor going even further, talking about the fact we're not in a rush. Maybe we're not in a rush to cut at all. Let's go back to Frankfurt. Lizzie Burden is standing by. Let's talk about what happens next, Lizzie. Governing council member after governing council member this morning saying very clearly we are not pre-committing here, we are data dependent.
You're absolutely right, Guy. It's been an about-face from Christine Lagarde. She'd been telegraphing that June cut since we spoke to her in Davos in January. So it felt yesterday that there was no choice but to cut, otherwise it would have been a huge surprise in the market. And yet they cut, while of course raising the inflation forecast for this year and next, which frankly, and I think I speak for the market here, felt weird. You saw the euro rising off the back of it, and this is a central bank that already faces questions around its credibility. You only had Austria's Holzmann feeling like he could dissent because of that recent economic data, the sticky inflation, the rapid wage growth. SocGen actually saying that this decision was data independent. So in terms of the path ahead, we've had a raft of ECB speakers this morning. You point to Makhlouf saying he doesn't know how fast the ECB will carry on, if at all. Muller saying the ECB shouldn't rush into another cut. Nagel saying that the ECB shouldn't be on autopilot. And Kazakhs saying that the ECB needs to cut gradually and dependent on the data. Guy, it leaves a sense of confusion here. Traders thought you were going to have 2 cuts this year. Now they only see 1. July seems off the table. A question mark over September now. And the more meetings this goes on, the more yesterday looks like a policy error.
Lizzie, great stuff. Thank you very much indeed. It's interesting, isn't it? The rowing back that we're seeing, maybe even a sort of tougher line being put on this story by some of the governing council members this morning. Lizzie Burden in Frankfurt, great work over the last 24 hours. Salman Ahmed's global head of macro and strategic asset allocation at Fidelity International, standing next to me. We pre-committed to the June cut. We got that cut, but now the poker face is on. The ECB doesn't want to tell us what comes next. Have we ended up having a cut and then this kind of hawkish narrative it appears developing? What does that tell us about the indecision, the uncertainty that exists now on the Governing Council?
Sure. I think I'm going to call the elephant in the room. It's the Fed. Basically, I think the ECB got into that pre-commitment mania when the Fed pivoted late last year. And of course, the Fed U-turned after that because obviously the data in the US economy was much stronger and the flow of inflation data, especially the stickiness, became much more clearer. But of course, as the telegraphed cut came through, now they find themselves in a position that what if the Fed doesn't cut at all? And then they are exposed. So I think they are trying to maintain and retain some optionality as we go towards the deeper end of the year, because I think they can also go back to the cutting if the Fed has a clear path of it.
The Irish Central Bank Governor is out with the line this morning, if at all. So we don't know when the next cut's going to come, if at all. What do I make of the if at all? How much of a danger is there that yesterday's cut was a kind of almost one and done? And what would that do to the credibility of the ECB, do you think?
So the credibility, I think, ultimately comes through from how the inflation pathway comes from here. So the good thing is that they have acknowledged that inflation is stickier. So you see now inflation not going below 2% by 2026. I think that helps them. But this one-off, with the benefit of hindsight, if they are not able to cut again, will look, a policy error, no doubt about it. But if you zoom out, what kind of world we are in, which is now high for longer and longer. And I think they are trying to acknowledge that because inflation is sticky and there's a growth rebound going on in Europe at the moment.
In terms of, therefore, when we think the next cut comes, what is your current thought process?
So we are in the view that Fed is unable to cut this year, not because they don't want to. I think they do want to, and I think structurally they are more dovish.
Powell's told us he wants to.
Yeah, he wants to. And it's very clear. There's no, you don't have to guess too much about that. But the data, we think, will not allow them to create that narrative to start the cutting cycle. And that has implications on the ECB. We think they would also like to cut once more, but the Fed window will not allow them. So it's interconnected, even though a lot of commentary we have seen so far is very unconditional focus on Europe, but US and Fed policy matters.
If we don't get significant rate cuts, is there a danger that the economic trajectory we are on at the moment, at some point policy is going to have an impact? Are we in the kind of no landing, hard landing scenario? The longer we leave rates on hold, particularly here in Europe, where the economy feels more vulnerable than we're seeing over in the United States, does that mean that ultimately, when a recession arrives, it's going to be more brutal than it potentially should have been if the ECB had taken a completely independent view of the world?
So no doubt that the tails are increasing. So, as you rightly pointed out, we are increasing this risk of a transition from hard landing to no landing to hard landing, and basically completely forgetting about soft landing. The critical factor of that will be the refinancing flows. Refinancing is going to pick up next year. That's when the effective interest rates will go up. A lot of the corporates refinance for longer terms during pandemic, so they have not been hit by those higher rates yet. But it is starting to happen. And that's why 25, because of the politics as well, fiscal policy dynamics, is going to be a very critical year, and that's, I think, where we can get a lot of things wrong rather than 24 or 2024 itself.
Why are we struggling to figure out what is happening? The central banks are really struggling. Yeah. Markets are really struggling. We are whipping around. This week, we've seen a huge rally for bond markets. Yields have come down really sharply, and I feel like I've watched this movie, we're only halfway through the year, 6 or 7 times. Why are we struggling so much? And when do you think clarity re-emerges in terms of our understanding of what is happening with the economy? Are we still in the post-pandemic kind of hangover phase, and that's what's causing the problem with the models?
Certainly, I think the post-pandemic phase is still there, even though people have forgotten about it because it was a painful, traumatic period.
Yeah.
But the supply-side shocks were very severe, and that has, I think, contaminated a lot of the analysis, a lot of projections by key central banks, and the markets have gone into narrative wars. I think they are less focused on fundamentals evolution. They are more interested in narratives shaping market pricing, and that's why those faster cycles we are seeing. But I don't see that changing anytime soon.
Volodymyr Zelensky's just got on his feet in the French Assembly. He's going to be talking about how the war is evolving. Don't worry, I'm going somewhere with this. And the reason I'm asking this question is that what he's asking for is basically financial support. But this goes to a wider question in Europe, which is we need to rearm. Yes. We need to spend huge amounts of money on rearmament at the same time that we are dealing with the green transition, as we're dealing with an aging population, which requires huge amounts of money on social security. Europe needs to spend an awful lot of money. To what extent is that priced into the current bond market setup? And even if we do get rate cuts, the long-end yields kind of stay where they are because of the magnitude of what we're seeing in the geopolitics and elsewhere.
Yes, certainly. I think that is probably the most important legacy of the pandemic and the wars, I think, built onto that, which is that there is a lot of demand on governments to spend money. We've seen that in the US. We're seeing that in Europe, although one can argue there is more scope for fiscal stimulus, especially for countries like Germany, because the debt to GDP ratio are much lower. But it also means that they need more cohesion between the different countries, which has been, during the pandemic, that was probably the most strongest sign that, the system remained intact. So, yes, there is demand for capex, government capex going forward, and we think that the curves will have to be steepened. And the natural shape of the curve is quite upward sloping compared to what we are seeing right now.
That's a big shift from where we are.
It's a big shift from where we are.
Simon, great to see you. Thanks for stopping by to see us. We really appreciate it. Simon Ahmed, Global Head of Macro and Strategic Asset Allocation, joining us from Fidelity International. As I say, Zelensky is currently speaking to the French National Assembly. This after yesterday, we saw the French President, Emmanuel Macron, promising barrages, fighter jets and training. This ongoing spending on military rearmament and the defense of Ukraine is a story that we need to think about. Up next, we are going to be talking about what is happening in the tech space. We will do that next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're saying to ourselves, wait a minute. If NVIDIA is going to keep running like this, the only reason it should deserve to do that is if it's going to benefit a lot of other companies. And we began to look at what those other companies might be.
That's, of course, Kathy Woods of ARK Investment Management, talking about the concentration risk around NVIDIA and the big tech stocks and the kind of the cycle that we see existing. It was interesting, I was talking to a guest a little bit earlier on, talking about the idea that it's just a completely separate universe to the kind of the macro story that we're seeing elsewhere that's affecting broader markets. Let's talk about what is happening with the market picture and how capital markets in particular are evolving this year. Feels like a very different year, doesn't it, than we've seen over the last couple of years. Philip Drury, Global Head of Technology and Communications Investment Banking at Citigroup, standing next to me. Morning.
Great to be here.
Look, we've come up, I'm good. And I imagine you're pretty good as well. We've come off some pretty bad years, and it finally feels like the capital market story is beginning to evolve into something a little bit stronger. But my question is this, do the green shoots that we're seeing evolving in the United States starting to poke their noses through the soil over here in Europe? Yeah. Is that something that can be sustained?
Well, look, it's definitely been a much better first 5 months of 2024. So 22, 23 were difficult years coming off the heels of a record 2021. Yep. If we go through the products, debt financing has been very, very robust, right? There's a lot of talk on Bloomberg this morning around how many rate cuts are there going to be. At the end of the day, if you look long-term historical trailing, the 10-year at 4.30, it's a reasonable level, frankly, in historical.
Market can live with that.
They can, in historical context. And what's important is spreads are pretty compressed, very competitive debt financing market at the moment for clients.
A little compressed, they're very compressed.
Yeah, for sure. I mean, we have 8.2 on our high yield index. That's about, 360 bips over in terms of spreads over the Treasury. So reasonable levels. When we go to equity capital markets, we've started to see some IPOs in the US, and they've traded pretty well. So investors are seeing positive returns. In M&A, we've also seen green shoots. We've seen strategic bids come back to market. So that's been through synergies of combinations. They've been able to navigate higher financing that we've seen relative to the near term. We've seen 18 take privates greater than $1 billion. And we're starting to see private equity enter formal processes. That's a sign of greater confidence. Before, we were seeing more informal bilateral conversations, so there wouldn't be any taint if those deals didn't go through. Now we're seeing formal processes. Now, just on that point of, is that coming towards EMEA in the UK? It's earlier.
Yeah. How much earlier?
But we're starting to see it happen. I mean, look, Citi led the $14 billion of placement of London Stock Exchange on behalf of Thomson Reuters, Blackstone, and the consortium. So follow-on offerings are getting priced in the region. Convertible bonds are getting priced. We led the $5 billion Alibaba convertible. This will all be a precursor to the opening of the IPO market. And obviously, Aramco will price probably during the course of this morning, and that's a very, very sizable transaction.
Yeah, that feels like it's in a slightly different universe to maybe some of the other stuff that we're talking about.
Sure.
My takeaway from Super Return in Berlin this week, though, was that private equity wants to offload, and it can probably do so with its really good companies. The cream of the cream, they could probably exit. The rest of the portfolio is going to be a much bigger struggle. So are we going to see a kind of stop-start story here where we get a few coming to market, the good stuff comes to market, but then we've got to figure out what happens to the rest of the portfolio. How much strength is there? Does it go beyond, when it comes to IPOs, you think the kind of the top end of what portfolios have in them? How easy would it be to offload some of the other stuff?
There's a big focus on DPI, right? You hear a lot about it. So what's the ratio, distributions versus paid-in capital? So the pressure is certainly mounting. But private equity is options, right? You've got a very competitive debt financing market we've talked about. So you've got bank credit, you've got also the private credit as well. Sell-side M&A we believe will pick up. And the strategic bid that's coming into the market is meaningful. And as the IPOs start to come, I think you'll get some very, very strong companies, growth plus profitability coming first to the market, and then we'll reach out. But look, I think you have depth of capital markets. You've got a decent financing market. So I think they're private options for private equity and also public options. And that's a reasonable competitive universe that they have. They don't just have one avenue that they need to pursue.
Talk about the M&A story. What do you... a few months ago, somebody says to me, I'm seeing loads of deals. And you've seen some of those show up in the UK. There was a lot of activity that's starting to come through now. Just give me a sense of the kind of the tone of the conversation that we're seeing now. Is it continuing? Do you hear about the potential of more deals still to come? What is going on? What does the pipeline look like?
The pipeline's robust. The conversations are increasing. I think what's really interesting is the strategic bid that we're seeing. Artificial intelligence is driving a lot of that.
Yep.
Corporates today around the world are re-looking at their business plans and thinking, how does AI transform my company? And that is impacting their M&A decisions. So an example, Citi advised IBM on the acquisition of HashiCorp. That is an example. You saw the last couple of weeks Palo Alto Networks announcing their combination with IBM. You saw Microsoft's investment in the London Stock Exchange. We've seen OpenAI now, not just with Microsoft, but also announcing with Apple. So you're seeing these joint ventures. I was at the Data Cloud conference Monday and Tuesday this week in Cannes. The amount of conversation around data centers driven by AI, the amount of funding that will need to take place over the next 5 to 10 years is transformational. So AI is really going to drive M&A and transformation. And look, we've seen a weakness in software recently.
I was going to ask you about this.
Yeah, partly because of the distraction of enterprise spend around AI and data. Now, I believe, and we believe, that software will be a long-term winner, but they need to develop the AI incumbent capabilities before deployment.
So it's a bit of a zero-sum game at the moment. Okay.
I think so.
Great to see you, Philip.
Great to see you. Thank you very much.
Thanks for stopping by to see us, Philip Drury from Citigroup. Plenty more still to come. We'll take you back to what's happening with the markets. We'll get into that GameStop story. We're waiting to see exactly what Keith Gill has to say for himself. Roaring Kitty getting back onto YouTube. What do we expect there? That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Couple of things I want to flag to you right now, one of which is GameStop is up and up big, 32%. Obviously, it's a fairly volatile stock. We're waiting to hear what Keith Gill has to say. The other one is that we are watching the French National Assembly. Volodymyr Zelensky is currently addressing French parliamentarians. I can show you this online. There you go. That is currently the live picture you are getting from France. Obviously, we are seeing ongoing commemorations around the 80th anniversary of D-Day. That will continue a little bit later on today. Anyway, more to come. We'll be back to the market story in just a moment. We await at 8:30 Eastern the payroll number out of the United States. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Friday the 7th, good morning. What do you need to know? European stocks, Wall Street futures steady. We're awaiting the jobs data at 8:30 Eastern. The labour market is softening, but by how much in the United States? ECB officials cautioning against a rush for more cuts a day after the Governing Council delivered the June cut. What comes next, if anything? Plus, President Zelensky addresses the French Parliament, or he's doing so right now. This, of course, after a session yesterday that saw Emmanuel Macron promising Ukraine more military support. Good morning, everybody. This is The Pulse. I'm Guy Johnson in London. Live pictures coming out of Paris right now. The Ukrainian President Volodymyr Zelensky still addressing the National Assembly in Paris. This all part in some ways of the 80th anniversary of the Allied invasion of France, D-Day. Joe Biden, the President of the United States, making parallels, of course, to the Russian invasion of Ukraine. That story on many people's minds right now. Now, speaking to French television, the French President, Emmanuel Macron, says France will now send fighter jets, Mirage 2000s, to Kyiv and train thousands of soldiers to help the country continue to repel and push back the Russian invasion. Let's take a listen to what he had to say.
We will launch a new cooperation and announce the transfer of Mirage 2005 French fighter jets that will allow Ukraine to protect its soil, its airspace, and as early as tomorrow we will start a pilot training program and transfer of planes.
They're not going to get them for a while, though, which is an interesting question and raises an interesting question about how long this conflict is likely to last for. We're joined now by Bloomberg News Director for EMEA, Rosalind Matheson. Ros, let's talk about that commitment. They're not going to get them for a while. These 2000s are not, these Mirages are not going for a while, and it's going to take a while to train the pilots. Presumably that's therefore an expectation by the French that this conflict isn't going to end anytime soon.
Well, certainly it's a signal that they think it may. If they're talking about military equipment and training, which will only bear fruit for Ukraine, at least at the end of the year, if not later. And as you say, it's the older equipment. So really, Europe's at the point where they're kind of scraping the barrel with old tanks, old planes. They've sent a lot of equipment there already. They've sent missiles, obviously, also. But they're kind of really, who's replenishing the stocks at the back end for France, for Germany, for countries in Eastern Europe, and how quickly can that be done? They're quite clearly relying on some of their older equipment and sending that in because they don't really have very much else to send to Ukraine, and it takes time to train the pilots, even on these older planes. The Western, aircraft takes time to train them to be comfortable with using some of this equipment, and so that's really at least an acknowledgement, maybe not expectation, but acknowledgement that it's possible the war will still be going at the end of this year. We know that Russia's making a fresh push at the moment. They've been making some inroads, particularly in the east, the northeast of Ukraine. Ukraine's been pushing back heavily on that, but things are not going particularly well on the ground. And so the question is this war just going to run and run for Vladimir Putin? Is he happy for it to keep running and running? Is it to his advantage that it does so? And is there any other way out for this war to come to a conclusion?
We've seen a series of meetings. We saw this morning a bilateral between the US Defense Secretary and the French Defense Minister. What's coming out of these meetings? What came out of the meeting yesterday as well? You got Zelensky, you got Biden, you got Macron. They're all meeting, obviously, with the D-Day celebrations, commemorations. What is coming out of these conversations? Do we know?
Well, some of it's just the optics of, let's just make sure that Ukraine doesn't fall off the radar in the public consciousness. I mean, we've got the conflict in the Middle East, we've got the US election, we've got the UK election, we've got a lot of things going on. The war in Ukraine's been happening now for several years, and you can see naturally that, the fight in a way for it to remain front of mind for people, for countries, for policymakers is there. And so the optics of Zelensky in Normandy with the US president, talking to US veterans there, to talking with Macron, all of it is about just keeping it really front of mind for the public, because you need the public support for the political support to come for France, Germany, the US and others to continue to push for that financial aid and that military aid to Ukraine.
It's amazing. We've been talking to CEOs over the last few days, US CEOs, talking, and they're making that comparison directly between what is happening, what happened with D-Day. Dave Calhoun at Boeing was making that exact comparison and saying how important it is to remember that. Ross, thank you very much indeed. Bloomberg's Rotherland Masterson joining us. We've just seen the wrapping up of that address by the Ukrainian president to the French National Assembly. We've got a meeting coming up a little bit later on. Biden and Zelensky meeting in Paris today. We think that's around 11:15 UK time, 12:15 Paris time. We've also got this coming against the backdrop, obviously, of European parliamentary elections. That takes place. It started, but it continues over this weekend. This is a vote that will help set policy for years to come, 5 years to be specific. We've seen the Netherlands going yesterday. Ireland and the Czech Republic are voting today. The remainder of the 27 go over the weekend. We think we'll probably get results kind of early Monday, late Sunday night into Monday to get a view of what is happening here. We're joined now to get an update on what is taking place by Stephen Carroll. He joins us from Brussels. Stephen, we've just been talking about the backdrop of the war in Ukraine. How big an impact is that going to have on these elections?
I mean, if you speak to the political parties, it is the central issue in this campaign. They say that support for Ukraine and what the European Union can do to mobilize that support is the key issue facing Europe now. Let's think about what that means, though, in policy terms and for the European economy, because what the European Union actually can do is largely limited to the defence industry, and that's what European leaders have already committed to doing in the right back in March of 2022 in the Versailles Declaration, committing to ramping up joint procurement, increasing investment in the defence industry, building the machinery so that Europe can replace some of that ageing machinery that you were talking about there a moment ago, Guy, as well. This is what European politicians see as the key issue. But if you look at the latest polling from what voters ahead of these elections were interested in, they were interested more in cost of living, inflation, the economy and public health. They were the top issues for voters as well. Remember, this is an election happening in 27 European member states. It's to elect a European Parliament, but quite often national politics gets in the way as well, and the campaigns are fought quite differently in each individual country, and that has a bearing too on what sort of results we'll get when we get them on Sunday evening.
When we start to get those results, Stevens, there is an anticipation that we are going to see maybe broadly a move to the right. How quickly does this start to affect policy? How quickly is this going to feed through into the way that the EU approaches the challenges that come next? And how quickly does that have an impact potentially on how the leaders of Europe address those challenges as well?
It's a very clear signal that we will get from these elections as to how the electorate is feeling about these issues. And that is something that we, from analysts we've been speaking to on Bloomberg today, have been saying means that what you'll see is actually more likely the centre parties starting to drift to the right, to adopt some of those policies to ensure that they're reflecting that part and that interest from voters as well. There's going to be a question of a reshuffle in the European Parliament after this as well. There are parties that are going to move groups. There's a question too of how you'll build a majority to be able to support an EU Commission President. We know Ursula von der Leyen wants a second term at that job as well. Will she be able to build a majority coalition from the current three partners, or will she need to bring in somebody like the European Conservatives and Reformists who are further to the right group? So it'll be interesting to see how that plays out as well. That can happen quite quickly after these elections. We won't have the selection of, or the nomination of a European Commission President, because that comes from the leaders until at least later this month and likely into July. And then you have to get through the European Parliament process. So we are in a period of pause here before we'll see a reflection of that. But you'll be sure that those European leaders will be taking into account how people voted and how they're drawing up the policy strategy for the next 5 years. We could see those policies implemented even if those parties aren't in a governing majority in the European Parliament.
Stephen, great stuff. Thanks for the coverage. That coverage is going to continue over the next couple of days as we work our way towards that result. Stephen Carroll joining us from outside the Commission in Brussels. What are we going to do next? We're going to talk about security, how AI is reshaping cybersecurity. What is it going to mean? How is it going to affect industry? We're going to discuss all of that. The CEO of the identity verification firm Okta is going to be joining us next. Tom McKinnon, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
To have an AI game plan. In fact, in the SaaS era, which really got started in 2010, a bit before that, we used to say that every company needs to think about becoming a software company or their digital side of their business. Now we say that every company needs to become an intelligent software company. And if you look at the buyers of our companies, all the exits we've had over the last 18 months, many of them are industry buyers that are looking to transform their companies through software.
Orlando Bravo there, talking to Danny Berger at the Super Return Conference in Berlin. He, of course, is the Tom Bravo founder, talking about the AI game plan that he thinks everybody has to have right now. AI is manifesting itself in a number of different ways, and the security industry is having to kind of deal with all of those different permutations to the impact that AI is having. And security remains one of the kind of key areas that I think a lot of people are focusing on. Security is becoming ever more important. You can see that potentially in some of the announcements that we're anticipating that Apple is going to be making. Bloomberg understands that Apple, remember we've got this big conference coming up Monday, Tuesday, will debut a new app next week. It's going to be called Passwords. Sounds fairly straightforward, doesn't it? It's basically aiming to make it easier for customers to log on to websites and software, but do it securely, because we now increasingly understand the impact that AI and various other products are going to be having in terms of that security story. Data breaches have become a growing concern for businesses across the globe, including the identity verification firm Okta. Shares in the company tumbled last October after it was hacked, though they've rallied significantly since then. Just kind of gives you an idea of the challenge and the evolution and the bumpy ride that we're all going through as we work our way through this process. The company's CEO is Tom McKinnon. He's standing next to me. Nice to see you.
Yeah, it's great to be here. Thanks for having me.
A pleasure. Look, AI represents an opportunity and a threat to your business. Kind of how are you thinking about its evolution and how it ultimately changes what you do? You do identity verification. We're hearing all kinds of stories already about how AI is so good at mimicking all of us that identity verification is becoming a harder and harder challenge.
Yeah, I think there's a tendency to think about this from the technology perspective, but we like to start from the customers. And what are the customers struggling with, and what are their opportunities? And we have great customers here in the UK, customers like Virgin Media O2 or Mars.
Yep.
And what they're thinking about is the opportunity. How can they build new products and services? How can they use this new smart wave of technology to better address their customer needs and their markets and fend off their competitors? And identity is at the center of that, because all of those new AI innovations need to be delivered to people. It has to be easy to access, and it has to be secure. So that's the lens we look at it from. And again, it's an opportunity, but it's also a threat. The threat actors can use AI as well, and that's why it's incumbent upon us as the technology vendor to say, hey, how can we help customers meet this opportunity, but at the same time defending the bad folks? And we're used to that. I mean, there's always threats with every wave of technology.
How is how I interact with companies going to change? How is I, as a vendor or a customer or a supplier, going to change in the way that I interact with these customers? How, as a customer, as an individual customer, am I going to change the way that I interact with these companies? Verifying my identity is going to be more and more critical, and ensuring that I am who I say I am is going to be really pivotal.
Yeah, I think that's right. And hopefully the dream of Okta and our customers in the industry is we want it to be easier. Yep. This has been too hard. The fact that Apple has to release a password manager, what that means is that we have too many passwords. Yep. So we want to eliminate that. We want to move to modern biometric authenticators that can't be phished. We want to make it easier for people to connect with these services. ChatGPT from OpenAI, Okta is the login for ChatGPT. We're helping them provide passwordless login to ChatGPT. So it's all about making it frictionless. And
so how does that? How am I going to log it? How is it going to change in the AI world? Because I'm hearing stories of people logging into systems using sophisticated AI that looks like me, that has the biometrics that resemble me. How does the way that this story is going to evolve change?
Well, I think the technology has to continue to advance to meet that threat. It used to be that people would fake your password, and we had to come up with biometric authenticators. And security is an adversarial relationship. So the threat actor is going to try to up the game and try to fake biometric authentication. They're going to try to have deep fake videos to have proof of verification. And we have to keep upping our game to deploy the technology to meet that threat.
So how are you evolving your company to do that? What is happening with it? Are you changing your acquisition strategy? Are you changing your talent acquisition strategy as well? How are you changing the way that you approach what you do?
Well, one of the big changes is we released a capability called Okta AI, which combines all of the data we have from our over 7,000 plus integrations on our platform and our over 19,000 customers, and we're pumping that data into various AI models and capabilities so that we can provide new products, like a new product we just announced called Identity Threat Protection with Okta AI, which uses all that data to detect threats and then protect customers from the emerging threats based on the threats in the past.
But you having to upgrade, are you spending more, basically, I guess is the question that I'm really getting to. What does CapEx look like right now? All I hear about from big technology companies is that their CapEx is going through the roof because of AI. Is that something that is being replicated with you?
It's definitely an investment. For us, most of the
definitely an investment.
It's mostly we're leveraging some of the great work from the cloud companies and the infrastructure hyperscalers, right? And then combining that with the unique data set we have and the unique capabilities in our platform to do something that's pretty efficient in terms of delivering values to the customers.
So where are you investing then? If you're basically using the cloud, harnessing the hyperscalers, as you say, that are investing so much in NVIDIA chips and everything else that comes with it, where are you having to invest to make this work? And is CapEx rising as we go through this AI cycle?
It's basically R&D for us.
Right.
It's smart software engineers, smart product designers, making sure those capabilities are mapped directly to what the customers need.
And is the market evolving differently in the United States to over here in Europe? How does the picture...
It is one thing interesting in this wave. In past technology waves, it seemed that the United States was first and maybe the interest and the adoption in Europe trailed. This one seems to be the interest is kind of running in parallel. Everyone is as excited about the AI capabilities, whether I'm talking to a great European firm or a US-based firm.
Do you get the sense that everybody's figured out how to use AI yet?
Well, I think it's been, in the R&D labs, it's been going on for 10 years or more. Yeah. But I think the great applications coming out now, like ChatGPT, it's really making people have a concrete example of how valuable this could be. So it's turned the investigation and the experimenting and the deployment into overdrive. And I think within the next 2 to 4 years, you're going to see many more applications that are going to change the world. It's going to be amazing to watch.
Todd, thanks for stopping by. Great to see you. Thanks very much indeed for joining us here in the studio. Todd McKinnon, Chief Executive and co-founder at Okta. Thank you very much indeed. Coming up, we'll take you back to the market story. We're awaiting the jobs data. That's expected to drop at 8:30 Eastern, 1:30 UK time. That's the big catalyst that we're waiting for. Markets reasonably moribund as we await those numbers. We'll discuss it next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Are we today moving into a dialing back phase? I wouldn't volunteer that because, as I said, we are making a decision on the basis of the confidence that we have that we are on a path. We know it's going to be a bumpy road, let's face it. The next few months will continue to be bumpy.
Christine Lagarde cutting rates yesterday, but keeping her cards close to her chest as to when the next one is going to come. We see the series of ECB speakers this morning certainly indicating that story. The Irish Central Bank governor suggesting that we may see a period where we don't know what's going to happen, and maybe we don't even get further cuts coming through. MLive strategist Ven Ram joins us now from Dubai. Ven, what are the chances that the ECB is one and done?
I think those chances are kind of remote. I think that I hear the Irish Central Bank governor, but I think that, he's not the only member on the governing council. And I think there are quite a few doves on the governing council. But I think the point of his message is that, you can't expect back-to-back successive rate cuts. This is not a normal rate cut cycle. So I think that the ECB will go in measured steps here, particularly because they've revised up the inflation forecast. And if you look at the real policy rate for the ECB, it's about 100 basis points. So if it's about 100 basis points, there's not too much of a headroom to cut. And that's, I think, the takeaway message from Makhlouf, rather than thinking that, they're not going to be doing it again. So I do think that it's not one and done, but it's going to be measured cuts.
Okay, so maybe we'll get another one maybe towards the back end of this year. Certainly that's what the market is pricing right now. Let's talk about 8:30 Eastern today. We get the payroll number. The survey number is 180. The whisper number is in the kind of mid-160s. We've seen a decent rally in the bond market this week, but with that kind of a setup, is there a danger that bond rally hits a wall when we see that data dropping?
The bond rally is self-limiting, Guy. There's no question about it, because, I expect, if it's 180, 170, it doesn't matter. It's going to point to yet another month of continuous expansion that we have seen for 3 years now. So the jobs market is pretty robust. So unless we get a big shift, a downward shift in the hourly earnings number, and an increase in the jobless number, I wouldn't get too excited about today's payroll data, because the Fed is going to look at it as an incremental piece of evidence that the economy is kind of cooling, it is losing momentum, however you want to characterize it. But, with 2% inflation still not in sight, and the economy just humming along okay, this is going to take a hard landing for the Fed to be cutting rates, which is why it's hard to see the front-end treasuries rallying too much after the data.
We've obviously seen significant volatility in Indian assets over the last few days and as a result of the election. Big dip in equities in particular. The Nifty's now kind of recouped that, so the market's bought the dip. Do you think the market's now got momentum? The equities, Indian equities have got momentum here to the upside. Does the buying of the dip continue?
No, I don't expect the buying of the dip to continue, Guy, simply because markets are kind of overbought. If you look at India's market capitalization vis-a-vis its GDP, it's running at some 120%. So the markets are the most frothy in India, outside the United States, anywhere in the world. So the fund investors are invested to the gills on Indian stocks in particular, not so much the bonds. So they are heavily invested in Indian stocks. So what is the proposition to invest the marginal dollar in Indian stocks? At the moment, it's very little. Over the short term, I expect there to be a correction to 67,000 levels on the Sensex. But the longer term, if India's economy grows as well as the RBA thinks that it is, they revised up the growth forecast earlier this morning. And if it continues a pace to grow at 7%, in 5 years' time, the Sensex and India stocks will be doing very well.
Ven, have a great weekend. Thank you very much indeed. MLive's Ven Ram, thank you very much. So we've got a Biden-Zelensky meeting coming up at 11:15. This is UK time. We've got, obviously, the big payroll number coming up as well. Steve Wozniak is going to be joining us Monday. Obviously, it's the Worldwide Developers Conference at the beginning of next week for Apple. That's going to be the big story next week. This is Bloomberg, the briefest.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities
could face bigger challenges.
Was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fix Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Menace Craney. Welcome to Bloomberg Brief. Let's set your agenda. Is a steady slowdown underway? The countdown begins to the U.S. jobs report. A mega deal in the works, Aramco's secondary stock offering, is said to raise at least $11 billion, making it the biggest deal in 3 years. Never-ending boom time. TSMC's monthly sales rise 30% as industries race to secure AI chips. A very good morning. Any sense of nervous exhaustion in these equity markets is well hidden. $4.6 billion flowed into equities, the 7th week of money flowing into equities. You've now got Microsoft, Nvidia, and Apple worth more than the entire Chinese stock market. But the path of least resistance, according to Morgan Stanley Lisa Shallett, is one of a grind higher. The path of least resistance is higher. A couple of stocks to note. You've got GameStop at the bottom of your screen, up 34%. I mean, we're up just under 70% now in 2 days. Keith Gill will take to YouTube later on this evening. It's a must-view for you. But these meme stocks, you cannot ignore them. Ignore them at your peril was Amy Wu Silverman's notification from RBC earlier in the week. TSMC, as we said, the May sales rose by 30%, again, invigorating the overall chip narrative, the insatiable demand for chips. On the bond side, the bond bulls have been firmly in charge. We need a fairly soft number in the jobs report to spirit the yield lower again. Whisper number in the bond market, 165. Consensus is 180 in terms of the jobs report. It's going to be about a validation of this move lower in the bond market in yields if we get a softer number. And to the euro, the shorts have certainly trimmed their positions. We're back to 108.89. The ECB jacked up their inflation estimates, and McAuliffe, the Irish central banker, this morning saying, I don't know how fast the ECB will carry on, if at all, in terms of cut. Phlegmatic is how I would describe that board at the moment. There is only one event of the day. It's counting down to that payrolls report.
Looks like the labor market is cooling a bit, but it's moving into balance.
Until we see outright layoffs pick up in earnest, which is not where I believe we'll be, or even in the next couple of months, until we see that, the market has room to run.
We may see a little bit of a bounce back from weak April. But the labor market is slowing.
I think the bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low. We think we're going to see 140,000 payrolls, which is a further slowing.
If we get a payrolls number close to 160, that could actually be the Goldilocks sprint that we need.
This is really a lot of cross currents, and I don't think that the Fed's going to have it figured out in the next week.
Well, Frank Monkham is our guest this morning, Senior Portfolio Manager over at Antimo. And he writes this: Inflation Street is way too slippery. The only viable path to cut City is via the jobs road. Crucial NFP print today, and that is ahead of the Fed and the CPI. Frank, good morning. Good to see you.
Morning, man. It's happy to be here today on Jobs Friday.
Absolutely. It's going to take a heck of a soft number to really deliver momentum, more downside in terms of this yield. So suddenly the dual mandate will be the reason, the employment numbers will be the reason that we see the real possibility of a cut this year.
No, absolutely. You know, I like to kind of contextualize the current macro backdrop a little bit just to get a sense of how crucial this, jobs report is today. We've seen a slew of data this week, from PMI, ISMs, JOLTS, ADP.
Everything.
And we get central banks from, the other side of the pond starting to cut rates with the ECB, the BOC. But, the main event still is the jobs report today. And the reason being, there's just not enough, runway for the Fed here from an inflation perspective to get to target before the end of the year for these two cuts to materialize. So we're going to have to see a pretty significant deterioration in the jobs market for the Fed to move here. That is pretty clear.
But do you really see that? I mean, we're trying to run the numbers. I mean, they need a heck of a series of good numbers on the inflation side, on the disinflation side. On the jobs numbers, we've run some numbers. We're going to need to see jobs unemployment at around 4 1/8 on a 3-month average before you would call the technicalities of a recession. Again, that's a pretty high bar, Frank.
Yeah, that's a pretty high bar. I think, you know, the markets are looking, especially risk assets, are looking for a Goldilocks number about around 150K, more or less 10%. But anything below that, I think the threshold really for the Fed in terms of the bogey for the Fed to really start panicking and thinking about rate cuts here very rapidly between now and the end of the year is the 100K mark, right? And to your point about having to see a series of data before cutting, I totally agree with that. I mean, the Fed has been pretty adamant that they want to see a series of data. Same thing with inflation, right? We had 3 prints, 3 pretty hot prints early in the year, but the Fed didn't, you know, just panic and start raising rates. So same thing with the jobs market, right? And if you think about the word series, mathematically speaking, it's you need at least 3 data points to be able to have a series, right? Because if I say to you 1 to complete the series, most people would say 3, but it could be 1 to 4, right?
Which would play to what Waller intimated in terms of wanting several more constructive inflation prints. Let's bring it back to the bond market. You know, we rallied, we got 20 basis points. It's not what you call a furious rally, but it had momentum. You say cyclical positive convexity into a softening economy. I mean, my question to you is, what is it that breaks to the downside? What is it that you need to see in data to help the bond market break lower in yield?
I think it's going to have to be, like I said, you know, major breakdown in labor market data.
And that's going to be around 100,000.
That's going to be 100,000 on the 3-month moving average.
ECB jacked up their inflation estimates for this year and for next year. Again, and at the end of the last show, we just heard from Christine Lagarde where she talked about sticky inflation and she talked about a bumpy road. You have a tactical allocation to commodities because of this sticky inflation. Where exactly?
Well, the story of commodities now is slightly different. I think, you know, the current macro backdrop still is favorable to an allocation for commodities, but I think investors need to make sure that they remain a little bit more nimble here and watch out for the different you know, idiosyncrasies of commodities and the technicals around commodities. I think it's more of a story of you know, being tactical and agile around some relative value plays, you know, within the commodities complex. Say, you know, energy to metals RV plays, relative value that is. So we've seen recently, for instance, you know, a lot of fund managers playing, you know, copper against oil, right?
Yes.
So these are the types of plays that investors are going to have to, you know, kind of be agile on instead of just having a beta allocations to commodities where we are in the cycle today. So I think it's more around finding, you know, if you have a stock picker mind, it's more about picking stocks here than buying the index, so to speak. So you want to be tactical around copper, gold, oil, and be respectful of the technicals. I mean, we've seen what happened, you know, to crude oil here recently, where the market basically got derated, you know, because of a sequence of bearish catalysts, and we are today with the market that's kind of, you know, almost max short, you know, versus copper that's overstretched to the long side. So these are technicals that investors need to be watching as they allocate.
Do you think those pivot points come when you see that overstretch on the bear side in oil to the overstretch of the bull side on copper? You sort of dig a bit deeper into the technicals and you look for pivots.
Correct.
Lisa Charlotte over at Morgan Stanley, you know, I think it was a fairly straightforward analysis. The path of least resistance is to grind higher. You look at, I mean, what was it I said? Microsoft, Nvidia, and Apple. The 3 stocks are bigger than the entire
Chinese stock market.
It's a pretty gargantuan statement. You warn of complacency in the equity market. Now, the last time you were with us, you were warning, look, there's a possibility of a drawdown. There's sort of nothing stopping the freight train of the Mag 7 at the moment. But talk to me about what you are basically talking, this complacency. How complacent are we? How fully invested are we? And what is it that worries you so in terms of positioning?
Yeah, so what I'm worried about is, you know, this momentum, to your point, is very strong. That's undeniable. But I think there's a risk of this momentum kind of peaking here a little bit. Positioning is very overstretched. CTAs are max long. Asset managers are almost fully invested. You know, 150 basis points in cash. That's, you know, near. It's almost a 10-year low here in terms of cash allocation. So I feel like the only thing that's supporting this market really is the hefty amount of buybacks programs that are still very active in the marketplace. So I think the market is being very, very complacent. If you look at vol and skew on the S&P, for instance, that's really, really cheap. So I think investors should be looking at, you know, plays such as, you know, buying You know, some cheap downside protection by buying some puts. Perhaps, you know, you have at-the-money volatility on the 3-month basis on the S&P that's sitting at a 12-year low, right? So even if you're long the market, I think it's a pretty cheap insurance to add to your portfolio at the moment.
We're going to hear from Keith. I know that you're going to set your clock. I know you're going to be logged into YouTube later on this evening. I know you're going to make the strategic, tactical investment advice based on Keith Gill appearing on YouTube. I'm saying that with an ironic smile, but actually we shouldn't be smiling because Amy Silverman was with me from RBC on Tuesday, and she said, you know, do not decry what's going on with meme stocks, GameStop, AMC, because it does have an impact. It does have a material impact for institutions. What are you and the rest of the team talking about? As we're covering, you know, there's GameStop, up 33% this morning, up 70-odd% over 2 days. I know these are violent small stock swings, but they have some kind of residual impact on psyche, don't they?
No, totally. And I think, you know, if you look at a lot of people that are running risk today, you know, say versus pre-pandemic, you know, everybody has to have the ability to model these things, right? Because investment psyche and behavior has changed a lot with sort of the gamification of investing. So we have to be respectful of that. There's still a wall of money out there that's, you know, sloshing around, that's going to, you know, continue to chase these type of opportunities with meme stocks. So
do you think it's just retail that's playing those stocks, or is there some kind of hint of institutional behind that as well?
Well, I think institutional players are looking for ways to exploit this market, right? But I think it's mainly retail driven, but you can't have a one-way market, right? There's got to be two players, and I think, you know, institutional investors are looking for ways to capitalize off of that.
Frank, let's see what the jobs number gives us. Whisper is at 165. Wish you well. Counting down to that number, Frank Monkham there of Antimo, our guest, setting the agenda on Jobs Day in the USA. Stories trending on your Bloomberg terminal this Friday morning. China is said to be conducting comprehensive site inspections of its biggest mutual funds. The country's audit office sent a team of about a dozen staff, each to at least 10 of the top firms in the past weeks. The auditors screened through documents focusing on expenses. Japan's biggest banks are planning to sell $8.5 billion of Toyota shares. That's according to people with knowledge of the matter. The banks will sell in stages and take advantage of Toyota's buyback program to minimize the market impact. The NBA commissioner, Adam Silver, says the league will turn to expansion, possibly overseas, after it completes a new round of TV deals. Las Vegas and Seattle are both looked at as favorites for new NBA franchises. Mexico City is also considered as a contender. The only foreign team presently is the Toronto Raptors. Coming up, Saudi Aramco is about to rake in more than $11 billion from its secondary issuance of Aramco stock. More on the story. And later this hour, we drumbeat to the payrolls report with Dana Peterson, chief economist of the Conference Board. Context matters on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, today on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny in New York. Saudi Aramco is set to raise at least $11 billion from its secondary stock offering. That is the biggest deal globally in almost 3 years. Stephen Stuczynski joins me now. It's been a big week for this share sale into a falling oil market, with sentiment being challenged on multiple fronts. Stephen, good morning to you. The scale of this offering to foreign investors. You're in Singapore, I'm in New York. This was marketed in London, New York, and all over the world. How tough was it to bring this secondary offering this week at this time?
You know, I think from what our reporters were hearing, this had more overseas interest than the initial offering in 2019, I believe. And that could be for a number of reasons, right? I mean, one, clearly the picture for oil right now, the oil market right in front of us, is not terribly sunny, but Saudi Aramco is a pretty attractive company if you look at the money that they give out. If you look at their dividend, it's the largest in the world. They're going to give a $125 billion dividend this year. That's 5 times more than Microsoft, which would be the second in the world. So it did gain more interest globally. We don't have the exact breakdown, but that's what the reporters are hearing. So there was that interest there, certainly.
Let's just talk about the oil market. We've had, as Halima Croft called it, an aspirational taper, which His Royal Highness Prince Abdulaziz bin Salman has really actively come out and warned us, give it a day or two, reality will fall in. But, I mean, oil's down 3%. It's hardly what you call a taper tantrum, but we're still trying to understand this release back of barrels to the market later in the year, aren't we?
I think this is all a game of expectations, right? I think when you were reading the analyst reports a few weeks before the OPEC Plus meeting, there was this expectation that they would keep these curbs in place through at least the end of the year, because things are softer, right? The Chinese demand has been a little bit soft. U.S. driving has gotten better, but overall the U.S. picture was also pretty soft. Shale drilling is more resilient than I think people were expecting at this time of year, at this price level. So overall, them coming out to say that they're going to be adding barrels to the market, I think about 500,000 barrels a day by the end of the year in the fourth quarter, and 1.8 million barrels a day around this time next year, was a bit of a surprise to some folks. And while Saudi Arabia certainly is saying that the market, they're just reading the market tea leaves, and they're keeping the balance, they're playing it there. Seeing prices fall to this level isn't something necessarily that their leaders want to see, especially if they want to balance their budget, and doing so requires Brent closer to $100.
It does, not sub $80. That's certainly not what they need for the grand ambitions. I just wonder where the corridor is in oil prices to invoke the said pause. We got to wait and see. Stephen, thank you very much. Stephen Stuczynski there on Aramco and the oil market. As I say, we're heading for the third week of losses after OPEC's supply plan rattled the market. RBC Chief Commodity Strategist Halima Croft says to find balances in the oil market, you have to look into sanctions. I caught up with Halima Croft at the RBC Global Energy Conference.
Where I think you want to look for potential, like, in terms of like balances to the market, like what changes, like in terms of like where you could see volumes come on. You have to look at sanctions. And you have to say, is there potentially a move? Because if you listen to statements by people like Jared Kushner, like they're basically saying like Iran could do what it did in terms of like having basically the the terrorist proxy groups all over the place because they have the cash. And so like you need to close the ATM. But the interesting question is, would you see a President Trump come in and be like, we're going back to zero, and we're going to aggressively enforce the sanctions? Because you can talk to people, we have it in our notes, people who had been in the previous administration would say, like, give me 6 months, I can get $1 million off. But the question is, with like rigorous enforcement, but the question is, would President Trump really want to take $1 million off in 6 months? As some officials, we put it in a note because they were indicating that's what they thought they could do. Would they do it without a backfill? And when you put this to like even more powerful people who would be potentially influencing Trump, they would say, well, yeah, we'd probably want to backfill. And the question is then, can you get, like, if you were going to squeeze Iran.
So where's the backfill come from?
The backfill would have to come from the Gulf countries. And the question is, after 2018, would they front run a production increase? And I would say that is the thing that I think that they are concerned about. Like, we might do gestures, but like, are we gonna basically give you $1 million extra with your promise that you're gonna take $1 million off? Or are you gonna take $1 million off and we have a deficit in the market and then we'll backfill? I don't think we can expect after 2018 to have these countries be like, we'll take it on good faith that you are gonna do this. So like, let's put those barrels.
They want a deal in Congress. They want.
They see that like we're not going to say we're going to enforce it. They want to see that like we're real about this.
RBC Chief Commodities Strategist Salima Croft speaking to me at the RBC Energy Conference in New York. Coming up in the show, I look at what else is making the headlines around the world. Is there anything else apart from Jobs Day in the USA? We'll reflect on some of the moves from the European Central Bank and check in on these markets ahead of the jobs report.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
What's making news on the front pages around the world? This is what we've got for you. First up, the New York Times. The Israeli Prime Minister Benjamin Netanyahu will address Congress July 24th. Netanyahu is facing intense criticism as Gaza war continues. Some Democrats, including the former Speaker, Nancy Pelosi, have said that they would boycott that address. Financial Times leads with the UK tycoon Mike Lynch. Remember this story? Acquitted of criminal charges by a jury in San Francisco. Lynch was accused of deceiving HP in paying $11 billion for his software startup company, Autonomy. And Bloomberg leads with the China export story, surging 7.6%. That beat the estimates, but imports missed, indicating weak domestic demand. Speaking about China, just check out the gold price, because, of course, we understand that they bought zero gold in May, and they had been on a rampage, buying gold furiously. Likewise, a lot of central banks had gold dips at 1.48%. Its peak was 24.50, and oil slips again as the market digests the release back from OPEC+. This is Bloomberg.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you were the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
From our global headquarters in New York, a very good morning. I'm Manus Cranley. Let's set your agenda. Is a steady slowdown underway? The countdown begins to the U.S. jobs report. A mega deal in the works. Aramco's secondary stock offering is set to raise at least $11 billion, making it the biggest deal in 3 years. And a never-ending boom time. TSMC's monthly sales rise 30% as industries race to secure the AI chips for the future. A very good morning to you. Welcome to the show. It is Jobs Day, and so really there is the focus on the bond market. what have we got for you? Really today is about a validation of the narrative of the softer jolts, softer wages in the services report. BMO have a report out, 33% would sell any pop in yield, 54% are willing to buy any dip in yield. It's range trading. But the bottom line is the whisper number, we're looking for 166,000 in jobs. Consensus is at 180. Stocks, is there a sense of nervous exhaustion? Not from the flow show. $4.6 billion flew into equities for 7th week in a row. And the path of least resistance, according to Lisa Shallett over at Morgan Stanley, is really a slow grind higher. Two stocks to watch: GameStop up 32%. Keith Gill will take to YouTube later today. We'll understand maybe some of his motivation in terms of trading these meme stocks. NVIDIA, Microsoft, and OpenAI are, of course, all the customers of TSMC, which saw their sales rise by 30%. There you go, up 0.5%. So the stock narrative, there's no sense of nervous exhaustion there. The euro, the shorts have trimmed after a hawkish cut, one could say, from Christine Lagarde and her cohort at the European Central Bank. McAuliffe, the Irish central banker, says he doesn't know how fast the ECB will carry on, if at all. Again, reaffirming the narrative, this could be one and done from the ECB, or indeed just a hawkish hold. I managed to make that sound exciting, but everything's virtually unchanged. That's the job. Let's bring in Mike McKee. Let's make the jobs report. Countdown to the jobs report. A bit more exciting. With bated breath, we wait. Mike, good morning to you. We were just having a private conversation about the whisper number, so let's continue that. 166,000. And what would you say to that whisper number relative to the median?
Well, the median has come down, but this is the first time in a long time that the whisper number has come in way below what the economist forecast is. The market's been above the forecast for many, many months now, and it has proved out. But overnight, we saw a drop in the economist forecast as more estimates came in to 180,000. It was 185 yesterday. Earlier in the week, 190. Hasn't changed anything in terms of the unemployment rate or the average hourly earnings. We have average weekly hours on there because if the economy is really slowing, we might see a change in there. And the warning here is that you're going to not want to react necessarily on the first headline that comes out, because May has a seasonal adjustment problem in that with all the teachers who go home at that point and all the kids that then go to work at the swimming pools and the daycare camps and things like that, the BLS has trouble matching those things up. And so the May numbers tend to come in a lot lower. So the possibility of a downside surprise for technical reasons is also there. So, Manus, we could see a change in the pattern that doesn't mean anything, or we could see one, depending on the distribution of this, that suggests that the economy is slowing significantly.
It's interesting, though, that the street has got nervous, incrementally more nervous as the week has gone on, as you say, from 190 to 185 to 180. But then I wonder how much of that is sort of like inside the bubble, and that's what drives this lower whisper number. Wages are important from the consumer point of view. 3.9%, Mike. Now, 3.9% again, if it comes in at that level, again, would reflect one of the slowest growths in 3 years. That's what we had in the previous month. So there is this evolution of slowdown in income.
Here's the problem with that. If we want to keep making this more exciting, which I know you do at this hour of the morning, as the survey period this month for May ended on the 18th. It can end as early as the 12th. It includes the pay period that includes the 12th of the month, but the way the calendar fell, this one went past the 15th of the month, which when a lot of people get paid. So if people got raises, there are some economists out there who are looking at this and saying it wouldn't take much to move this up from a 3/10 forecast to a 4/10 forecast, and then maybe move wages up to 4%, just as a calendar quirk. So suppose we get a drop in jobs created, but a rise in wages, then you're going to hear that stagflation word again as people panic, because what do you trade on there? That's the hard part. And the good thing to keep in mind is even if we fall to a significantly low number, 166, it's still well above the number the Fed considers neutral for the economy, which is about 100,000. Anything higher than that is a pretty good payrolls report, even though it won't seem like it because we've been so high for so long.
Okay, Mike, I'm sure you, Jonathan, and Lisa will make it exciting. We'll tune in at 8:30 for those numbers as they come through. Mike McKee. Joining me now is Dana Peterson, Chief Economist at the Conference Board. Dana, good to see you this morning. So the street is getting incrementally more nervous, 190 to 180. It's not a huge shift, and there's the confirmation bias in the whisper number. In other words, inside the clack, they're all howling for a lower number. Is this just a confirmation bias day? Is that what the market is baying for? It wants confirmation of a gradual slowdown.
Well, I think the thing that Mike said is that anything above 100,000 is still a decent number, but it's all relative. And certainly, the big numbers that we saw in payrolls over the last couple of years was catch up. And so many industries have already caught up in terms of adding all the workers that they lost during the pandemic. And really the big drivers are just a few industries that are still trying to catch up. But we did see last month that almost all the increases was in healthcare and social insurance. Meanwhile, leisure and hospitality and government really pulled back. So if we see that pullback again, and it's really only one industry driving things, then we're going to see a labor market that's probably kind of topped out in terms of payroll gains.
Well, if leisure and hospitality, as you say, do show some kinds of perhaps slowdown, again, this reflects back to the wages component. Many people have said, look, the growth in jobs has been at the lower end, and the wages have been suppressed because the growth in jobs has been at the lower end. It's a bifurcated market. So what would you say to that if we do get a slowdown in those two sectors, and how that might play out?
Well, I think, the opposite thing is happening with wages. Wages were really elevated when you couldn't find enough people to work. But now, like I said, a lot of industries have found workers, so they don't need to pay up as much to attract and retain workers. But even still, it's that inflation issue where wages are much higher relative to where they were on average between the great financial crisis and the pandemic. Wages were growing, under 3%, and now they're just under 4%. So that's still pretty high, and wages are still putting upward pressure on consumer prices, which is something that the Fed is very concerned about.
You have a baseline, I think, as the market has, which is that growth will continue to slow. We've certainly sort of seen that in some of the assessments. Growth will slow in the second half. Torsten Slok puts out his note, and he talks about earnings, equity earnings will deliver the underbelly. Strong earnings will deliver high capex and higher fixed investment. That, in some ways, will help create a floor in growth. So what kind of slowdown do you think that we will get? And will that be commensurate with a more brutal unemployment situation, or will it just be a slow drift lower and very unlikely to crash to that 100,000 level of jobs created?
Sure. So the first thing is that earnings and what the stock market is doing doesn't reflect what the real economy is doing. The real economy has been slowing because consumers are pulling back. In the first quarter, consumers didn't buy any goods. And certainly the most that they're buying right now is services, and that could pull back. Certainly as consumers are still complaining about price levels are very elevated, and interest rates are also elevated. So that eats into spending, as well as the fact that the excess savings is gone, and also consumers have racked up a lot of debt. So we do expect that the economy is going to be even slower in the second and third quarters. But in terms of the unemployment rate rising, that might tick up a little bit, but not much, because much of the data suggests, if you look at jobless claims and if you look at our CEO confidence measure, companies are not letting people go. They're holding on to workers because of many people retiring. So that's going to put a cap on how many people get let go, even as the economy slows.
Yesterday, we saw the ECB raise their estimates for inflation for this year and for next year. And again, reaffirming that global narrative that it's going to be a bumpy road. Inflation will be sticky. It's going to be hard to call. Frank Monken was with me a little bit earlier, and he said, look, it's going to be tough. It's going to be bumpy. I mean, how sticky is this inflation for us with oil where it is at the moment, with the commodity pricing that we've got at the moment?
Sure. So when you look at goods, yes, oil is energy is starting to contribute positively again to inflation, but it's very little. Most of the inflation is in services, and it's basically in three buckets. It's in the shelter costs, which are going to continue to slow, but it's going to take the rest of the year. It's insurance costs, And then there are wages, the upward wages pressures. And so the insurance costs, we don't know when that's going to ease. Insurance companies are saying it's very expensive to insure cars because they're high tech. And also it's very expensive to insure homes because of all the climate events. But when it comes to wages, as long as companies are willing to pay up to hold on to workers, then you're going to have those upward pressures. And those are things that the Fed can't necessarily control. The Fed is controlling the shelter issue, but it takes a long time. But it's those other elements that are going to be a challenge and probably keep inflation sticky and make that last mile of getting back to 2% a lengthy process.
Dana, you're down for one cut in the fourth quarter. How convicted are you on that? Or is that getting emboldened? I mean, the market has gone a little bit earlier and maybe a coin toss for September. So how committed are you to one cut in December, or are you skewing to, Manus, actually, it could possibly rise to 2 this year?
Actually, we do have 2 cuts this year, November and December. And the thing is that even that's like a questionable issue, because if inflation doesn't continue to slow and it stays where it is because of those upward pressures I mentioned that the Fed has limited control over, then we might not have any cuts this year. But we are optimistic that the Fed can squeeze in at least 50 basis points. But even with that, you're still going to have a federal funds rate that's 5%. So that's still very elevated interest rates.
Still pretty much worthwhile to keep some money in cash maybe, as opposed to some higher risk assets, but then it could be that slow grind higher on the equity side. Dana, we're counting down to those numbers. We'll both get more information as the morning goes on. So too will the market. Dana Peterson off the conference board, my guest this morning, counting down to the jobs report. Coming up, the chip frenzy continues. TSMC's sales rose 30% in May, driven by AI demand. It isn't slowing down. Context matters on Bloomberg. Good morning from New York.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
today's Bloomberg Brief. I'm Menace Cranny in New York. It is the world's largest chip maker, TSMC, continues to benefit from that AI boom, seeing its May sales rise 30% to more than $7 billion. Let's bring in Tom McKenzie, never far from a chip story. I mean, it's just the ferocity every day with which we report on these stories. What caused that spike, or is that the beginning of a new demand iteration? Tom?
Yeah, Manus, it's a combination of two things for TSMC, and that's why these earnings or these results in terms of sales are particularly interesting. So for the month of May, year on year, a 30% increase, again, for this contract manufacturer. Here are the two elements that are interesting. One is they're starting to see a rebound in terms of electronics demand. So look into that iPhone, for example. They produce the vast majority of Apple's iPhones. The other component, no big surprise here, is that continued demand for AI accelerators. TSMC is the foundry that manufactures NVIDIA's GPUs. No TSMC, no NVIDIA GPUs. It's as simple as that. They have that symbiotic relationship. So those two elements coming together for TSMC, leading to that pop in sales from the month of May, year on year. Look, year to date, TSMC is up about 50%. It's the fact that you're starting to see a bottoming out, arguably, of the smartphone part of the business in combination with the demand for AI accelerators that is leading to the optimism that you're starting to see around TSMC.
Listen, I'm all in on the next upgrade for AI on my iPhone. I'm all in there. I'd even probably pay money for it. There you go. Actually, I don't know that I'd pay money for the AI. I'd like to do my own research. Okay, NVIDIA. The stock split is coming, and I've had a number of different guests come on, and it depends, you know, pay your money, take your choice. Democratization of NVIDIA, it means many more people can buy it. That's a good thing. But with that democratization, Tom, comes volatility. So talk me through the stock split. It goes live, and what are you hearing in terms of vol on that?
Yeah, 10 for 1 is the stock split. It's not the first time they've done a stock split, but of course this comes on the back of those blowout earnings. Of course, they've beaten quarterly earnings 7 out of the last 8 times. Most recent earnings, a big beat. They come out then with this decision around the 10 for 1. The stock is what, 1,200 or thereabouts. They said that they want to make it easier to access for not just their employees, but of course investors. Yes, so there's a risk. There's a cost, obviously, of doing this, a small regulatory cost, a small legal cost they have to pay. And then there is a question about volatility. It doesn't change the fundamentals, of course, doesn't change the fact you're still going to get your dividends split by 10 if you're a shareholder. That, again, doesn't change the fundamentals of this business. There's some research that maybe on the back of a stock split you get a bit of a pop. Maybe that comes through. We'll get a print or price on that on Monday, of course. But look, for them, the rationale is they want to make sure this stock and this share is accessible to as broad a group as possible in an environment where, again, tripled in value last year, up, what, 145% so far year to date.
Is there anybody can really seriously challenge NVIDIA or AMD in the near term, or do they have this sort of splendid lead time of dominance?
It does seem to be a consensus when you speak to the analysts that they have this lead time. The demand stretches into 2025 now. The fact that the demand is outstripping supply for NVIDIA, and that is expected to continue into 2025. We know that AMD, we know that Intel are upping their investments to try and close the gap, but the gap is sizable, because don't forget, it's not just the chips, it's also the services component and the software component. And Jensen Huang, clearly, we got a reminder of that this week. He's not sitting on his laurels. He's come out with this annual upgrade cycle, and again, he's pushing not just in data centers, that provides about 70% of the revenues right now, but also into personal laptops, the enterprise component, the sovereign component. And it's a company with, what, 60% or so margin. The question is, expectations around the stock, are they so high that if you get a bit of a misstep in the next earnings, does that knock things too far? The competition is a story worth watching. Some of their main customers, Meta and Amazon, are building out their own competitive chips as well. So that is maybe a longer term story.
Okay, Tom, thank you so much. Tom McKenzie there, tracking the tech stories of the day. To the oil market, it is a third week of losses as the OPEC plus supply plan rattles the market. This is the world's biggest producer, Aramco. It's set to rake in more than $11 billion in its mega stock offering today. There's the price of crude. Anthony DePaola joins me from Dubai. Anthony, good to see you. This was a tough couple of weeks to take Aramco the secondary offering to the market. There was competition domestically with some other IPOs, but talk me through the marketing of this and what was the message to global investors.
Yeah, good morning to you, Manna. So yeah, it's a big week in Saudi Arabia because we did have that OPEC meeting there at the same time as this Aramco offering is going on by the Saudi government. And the real value proposition there is the dividend. I mean, they've got this massive dividend, $124 billion this year, and that's roughly $30 billion more than they paid out last year. So it's a big jump, and that's still that special dividend that they're paying out based on the bumper earnings of 2022. And they're talking about keeping that special dividend. We don't know the level yet, but keeping some sort of a special dividend going forward in years coming forward. So they're really trying to attract investors in with that dividend. The shares do look a little bit expensive compared to other peers in the market. So that's one issue that investors will have to look at. And there's that issue of the reduced production in Saudi Arabia because they have to abide by those OPEC plus agreements. So really, shareholders are kind of asked to invest on the strength of that dividend, investing in a company that's not really able to produce as much oil as it could. So that's the issue. That big government overhang in terms of decisions on Saudi Aramco is one of those things that have kept investors skeptical about Saudi Aramco. But we have seen more international interest in this offer now than we did in the IPO, which was in 2019. So investors rather, seem to be more used to that company now, Manus.
Yeah, to be fair, I mean, they had to price it at, what, 6% discount, and some of the other secondaries have gone at 10% discount, so they didn't have to throw it away. Briefly, is the market becoming more accepting of the release back? Just briefly, Anthony, I mean, Hilly McCroft called it an aspirational pause, is what OPEC Plus has said. They're going to release the barrels back, but they will hit the pause button if they really need to. Did that really get reaffirmed this week?
Yeah, I mean, I think that was the big message yesterday when the Saudi energy minister and the UAE energy ministers were both in St. Petersburg next to the Russian energy minister. So they really talked about the possibility of pausing that and not going ahead with that. So the market was already looking at this a little bit skeptically, doubtful as to whether there was the space to bring those barrels back. Now it's put up into question, what will they do? Will they bring those back? Will they not? We'll have to see how the market is, Manus.
Okay, Anthony, thank you so much. Anthony DePaolo there in Dubai, tracking the oil stories. Coming up on the story, there is only one event that matters. It is the jobs report. Your whisper number at the moment stands at 166. It's a beautiful day. It's dawn in New York.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Was going to keep Real World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond. It's Bloomberg Brief. I'm Menace Crenny in New York. A look at the rest of your day. It's only one focus, 8:30 a.m. Eastern. The jobs report, the whisper number stands at 166. That is followed by wholesale inventories at 10 a.m. And President Biden delivers remarks in Paris at 10 p.m. Eastern. Some stocks that are on the move. GameStop. Tune into YouTube. Keith Gill schedules his return on Friday. That is going to be a first that we haven't seen in 3 years. GameStop up 70-odd% over the past 2 days. DocuSign extending post-earnings decline amid weak guidance, and Robinhood extends its rally after announcing to buy the European crypto exchange Bitstamp. There is only one market that really dominates everything. It is the tail that literally wagged the proverbial dog, and that is the bond market of the United States of America. We're counting down to the jobs report. And there you go, 5 days down 20 basis points. You need to see something significantly below 166 to invoke a move lower. JP Morgan, Citi are the last stand saloon. They're going for a July rate cut. I applaud the optimists out there. Let's see what the job report gives you in terms of jobs, hours worked, and wages earned. And the survey at BMO says, sell a pop in yield. Good morning from New York.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Suppose the unemployment goes up, but job growth stays strong. That's sort of a perfect scenario.
I think we're going to a more normal, gradual pace of job creation.
We should be talking about the other risk. Employment could really weaken.
I don't think 150 would be such a bad number.
The soft data has been telling us that the economy stinks. It's the hard data that is actually going to move the needle.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance coming into payrolls Friday, just off all-time highs. The equity market heading towards a decent week of gains on the S&P 500. The payrolls report, 8:30 Eastern. The estimate, 180K. Look out unemployment. This stat from Jim Reed at Deutsche Bank this morning. If the unemployment rate stays beneath 4%, then it would mark the longest stretch of sub-4% unemployment for the U.S., Lisa, since the early 1950s.
He also drew the parallel with the outperformance of equities during the 1950s. I would draw an additional parallel, which is this comes after a period of tremendous fiscal support following the war, and so you could draw that parallel as well. Nonetheless, you have that side of things, then you have the Andrew Hollenhorst side of things, which is this is going to be the pivot point at which we see real weakening with 140,000 on the payrolls number.
You mentioned Hollenhorst, so the call from Citi and JP Morgan for a rate cut in July, I think we've got to say it, hanging by a thread at this point. It's a two-part act. We'll get payrolls a little bit later this morning, CPI on Wednesday, then Fed decision. It's got to go their way, hasn't it, for July to work?
And they even acknowledged that. I mean, Andrew Hollenhorst came out with this, saying May employment data will be crucial for either reaffirming or contradicting a growing market realization of the downside risks for a previously resilient U.S. economy. I would argue that when you take a look at the peripheral data, especially with the K-shaped economy and some of the lower income households really retrenching some of their spending, if we don't see it in the data, are we just saying that we're not going to see it in the data? Or is this going to be something that's just pushed out to a 2025 phenomenon at this point?
What do you think is bad news today? 180 is consensus. I've thrown out a couple of numbers. This from Bank of America, below 125. Bad news could become bad news. The guy sitting next to us, who we'll catch up in just a minute, headline payrolls below 150 would be worrisome.
Anything that is also accompanied with a rise in the unemployment rate, I think also could be worrisome, in addition to potentially downward revisions to prior months, particularly April. It isn't going to just come down to the headline number. It's going to come down to, yes, average hourly earnings, although that's been de-emphasized in a lot of the reports that I've been reading. It's much more about the actual unemployment rate, as well as some of the internal dynamics that people get a sense of.
Let's turn to the scores. Welcome to the program. Equity futures look like this on the S&P 500, totally unchanged, very close to all-time highs, just inching back a little bit at the close yesterday. Bond yields have been much, much lower over the past week. We're just a little bit higher this morning by a basis point at 429.86. Plenty of talk about the ECB. We'll save most of that for later, but just briefly, 108.93 on the euro. Did you see the necklace that President Lagarde was wearing yesterday?
I missed it.
I'm in charge.
Okay. That's what I said to you?
In charge.
Well, I mean, look, she's in charge, and then afterwards everyone comes out and says, okay, quit it. We shouldn't have done this. But, you know, I think that what the sort of conflict was and what became clear as this press conference went on was that you got most of the council to agree on a rate cut. And the nod to them, the sort of concession prize, was to basically say, okay, the guidance will be incredibly hawkish, and we're basically going to take it off the table for the rest of the year. And that's what really explains why you have this completely nonsensical phenomenon where you're upgrading inflation forecasts but cutting rates.
We said something yesterday that turned out to be true, so I think we should just sort of pause and reflect on that briefly.
Take a victory lap. Go ahead.
Not just me, I think you as well. It's never about the ECB statement. It's never about the ECB news conference. There's something uniquely European about this. In the hour after the news conference finishes, all of a sudden there are anonymous sources saying what they really think about policy and where it's going to be over the next couple of months. And that's precisely what happened yesterday. Fantastic reporting from the team here at Bloomberg. July's a non-starter, and September might be too.
So now people are ratcheting back their expectations for rate cuts to maybe just 2 this year from the ECB. Again, this goes to this question. We were talking about divergence. What divergence? I mean, honestly, we're talking about the Fed and the ECB on totally different tracks. It's looking like it's more convergence than anything else.
Mohamed Al-Arian on that point a little bit later this morning. Look out for that conversation. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, staying long equities until there's a crack in the labour market, win thin of Brown Brothers Harriman on the ECB's hawkish cut, and Michael Pugliese of Wells Fargo expecting another strong payrolls print. We begin with our top story, US stocks sitting near record highs as we await the jobs report. Stuart Kaiser of Citi saying this: payrolls may be a banana peel. Headline payrolls below 150,000 would be worrisome. Stuart's with us around the table. Stu, good morning.
Good morning, how are you?
What is it about 150, sub 150, that you think might shake this market up a bit?
Yeah, I mean, there's a debate about it, but like rule of thumb, 150, kind of your break-even level on payrolls, and once you get below that level, you should see an inflection higher in the unemployment rate. Also, effectively, you'd be going from a run rate that was somewhere in the 275 range for, 3 or 4 months, and then you'd be kind of step functioning your way down, 175, 150, and again, back-to-back large misses of consensus, which I think is important as well. So I think it's the level, it's the trend, it's where it comes in versus expectations. So there's a lot of moving parts, but I think you have to pick a number. So 150 is the number we're going to kind of work off of and go from there.
And consensus of the team is 140. Your Mr. Good News is good news. Can we just sit on that for a moment?
Sure.
You don't believe in this bad news is good news stuff at all?
No, not even a little.
Why not?
I think it's like, I don't know, it's like rooting for yourself to sprain your ankle because you like the physical therapist and you want to go there. I just don't understand it. I mean, U.S. equities are a nominal growth asset. If you're investing in them, you want growth to remain strong. The other reason right now I don't agree with it is because if you're hoping for weak payrolls so the Fed may cut, you're really trying to thread a needle there, right? Because I think once you get payrolls sub 150, the chances that you kind of inflect negative, which is something Andrew and team have highlighted, really, really increases. So now you're saying, I want payrolls to be low, but not too low, so the Fed will do a few cuts, but not too many cuts. There's just too many kind of contingencies you're relying on there. I'd rather we just keep printing 175 and not have to worry about it.
All I can say is that analogy that if you sprain your ankle so that you can see the physical therapist that you like, I don't know, it's complicated. And I'm sitting here, but I digress.
You like your physio? What's happening here?
Let's move on. So let's talk about the fact that you... I'm just saying, it's
sure
complicated. All right, let's move on. Happy Friday. It's Payrolls Friday.
You did this, not us.
It's complicated. So when you're talking about potentially the response of equities to bonds, it kind of goes to what Michael Hartnett was talking about, that he actually sees lower bond yields as being negative for stocks for the same reason that you do. Are we saying at this point that any rally in bonds is not going to give any extra juice to stocks in the foreseeable future because there only will be a rally on weaker data?
Yeah, unless you're able to thread that needle. So like what we've said is the Uber bull case, right, is soft landing plus insurance cuts. So if you're able to kind of soft land the economy, keep payrolls, let's say, in the 100 to 150K range, and you get a couple cuts on the side of that, I think that's very, very bullish. My view, though, would be as payrolls are decelerating to that level, the market's going to get spooked anyway, right? Because as payrolls slow, you have to increase the odds that they kind of overshoot to the downside. So, look, I think there's a very narrow window in which lower yields can help you, and that is an insurance cut kind of scenario.
It sounds like you're more bearish than you have been in a while. Is that true?
I would say the risk reward feels probably as bad as it has, I would say, in the last 12 months or so, give or take. If you look back, the last 12 to 18 months, I think there's 3 times that we were kind of recommending hedging and kind of being careful. One is SVB, we can kind of throw that away. But in August, you had claims kind of tick up. In October, you had payrolls get revised down to 105, right? So we've had data that kind of looked like this episodically in the last 12 months. I think the difference right now is the weakness feels a little broader. And the economic surprise has been quite negative. So you're kind of missing consensus in a more broad-based fashion. Plus, you have S&P at all-time highs, right? So that kind of combination, does make me a little bit uncomfortable. Our base case is still positive, but we're kind of looking over our shoulder a little bit.
Although at this point, a lot of people say, well, NVIDIA, that's all you have to say. Gensanity, it's going to drive everything higher. At what point can you really bet against Gensanity?
Look, I think NVIDIA's been an interesting one. I think earnings were very interesting, right? I'm not going to get my T-shirt signed or anything, just by the way.
We won't go there.
Well, you're in a situation there where I think this past earnings season, if you claim to be AI but didn't show it in your revenues, your stock got kind of hit, right? So the NVIDIA story is there, but this kind of AI adjacency story has come under a little bit of pressure. And I think that it also creates the sense of a little kind of risk or weakness in the market around the edges. I mean, look, if NVIDIA can keep posting $2 billion of beats on a consistent basis, that's really positive, but law of large numbers, you kind of run into that as well. So it is a huge theme. I'm not going to, poo-poo it, but it's certainly kind of, later innings, it feels like, in terms of the beat and raise story. And people are starting, I think, to ask legitimate questions about, can anybody other than NVIDIA actually demonstrate AI-based revenues?
Can you tell us, does that apply to utilities as well, given the run-up they've had in the last month?
Yeah, I think utilities, I mean, they would be in that AI adjacency kind of camp. Yeah. I think the difference there is you have EV rollout, you have AI, you have potentially like quantum computing stuff, and you just have the Inflation Reduction Act that's just now kind of, those revenues are just hitting. So I would put I put utilities in that category, but they at least have a couple other things they can fall back on as quote unquote protection.
There's a lot of people who think AI is in the job destruction business, so why would NVIDIA care what the jobs report looks like at 8:30 Eastern? Why is it even relevant to what NVIDIA's doing? Just
sentiment, I guess, sentiment positioning. That is a narrative, right? More AI, less jobs, more free time, yeah.
Honestly, well, what I find interesting, it's a good question, and there are all these potential changes that supposedly were going to happen. Michael Darda over at Roth MKM put out this idea that we're not seeing a real boost in productivity, and actually it's falling off a little bit. And he said the burst in non-farm productivity during the second half of last year likely had very little to do with artificial intelligence. Is that basically your read through too, that this whole idea of like the productivity boom on the heels of AI was a bit overinflated and isn't going to really create this virtuous playing field for a lot of these companies?
Yeah, I think that there's two things you can be a little skeptical about AI. One is a lot of companies are already doing some form of AI already, right? Like a lot of banks have some form of AI. A lot of the help centers use kind of a little bit of AI already. And then the next step of AI productivity gains is probably not immediate, right? It's going to take a little time to kind of, to bake itself in. So I think his comment is just that, is that the promise of AI productivity gains is actually not here and now, which may be 4, 8, 12, whatever quarters out. And I think that's one of the differences a little bit between AI and, let's say, the internet back in the late 90s. The internet, you were going from 0 to 100. AI, it feels like you're actually starting in the 40 to 50 range, and now we're kind of accelerating from there. So it's like the inflection is potentially a little bit less.
So let's just finish where we began, which is what would you have to see on payrolls, not to be bearish, but to be overwhelmingly bullish once again, and to say, you know what, I am completely positive, more so than I had been just yesterday.
Honestly, I think if we print anything over 175, we're going to be feeling pretty good about things.
Pretty narrow delta.
Well, it's
150, it's misery. 175, it's great.
Hey, welcome to the internet economy, and I don't know what this is. Social media, right? You got to put a line in the sand or step on one side of it. But look, I think if you get a consensus print, markets are going higher. And then I think the other thing we haven't talked about is what does the payrolls report do to you in terms of FOMC, right? So I think if payrolls are very weak, I think the FOMC becomes a much bigger event.
Okay.
If payrolls are pretty solid and strong, I think the FOMC becomes a little bit less important on the margin.
Piece of this we haven't sort of mentioned, so let's address it. What if it's like really, really strong? A little bit later this morning.
Still positive.
Still positive.
Yeah, I'm still positive on that. If you printed, I don't know, 225, but your average hourly was 0.4, then the market will, reorient itself back to inflation risks, and that will kind of be maybe a little bit of a negative, and that brings the Fed back into play. Okay. But just payrolls, headline payrolls themselves, can't be too strong.
What about 290?
290?
310. 320. It's a lot of scenario analysis going on here, isn't it?
320 plus 0.2, we're okay.
Thanks, Stu. Appreciate that. Super precise. Stuart Kaiser of Citi. Love that. 175 plus, great. 150 sub that, terrible. Let's get you an update on news elsewhere this morning. Here's your Bloomberg Brief with Yahara Haggis. Hey, Yahara.
Hi, John. Saudi Arabia is getting ready to cash in on its secondary offering of Aramco shares. The government is expected to sell more than 1.5 billion shares for $272 apiece at the bottom half of the proposed range, according to people familiar with the matter. The sale is expected to raise at least $11 billion, the biggest global deal in 3 years. It will help fund the government's multi-trillion-dollar push to transform the kingdom's economy. Israeli Prime Minister Benjamin Netanyahu accepting an invitation to address both the U.S. House and Senate on July 24th. This coming as he faces intense criticism over the civilian death toll from the war in Gaza, which has led to public disagreements with U.S. President Joe Biden. A joint statement from both House Speaker Mike Johnson and Senate Minority Leader Mitch McConnell, both Republicans, saying the meeting symbolizes the U.S. and Israel's enduring relationship. And TSMC is getting a boost from the artificial intelligence rally. The company reporting May sales rose 30% to $7.1 billion. TSMC is the exclusive manufacturer of NVIDIA's most advanced AI accelerators and also makes semiconductors for Apple and